Don't want to get us behind. So I think we're ready to go. Brian, we're good, right? You're good? Looks like we're all set up.
I'm good.
All right.
Let me just go and meet people, make sure everything's
Okay.
good.
Hold your questions. We'll cover them this evening too. If you have anything else, you want to discuss.
Point out you still haven't reset your computer.
Oh yeah, that popped up again. Man, why do I forget that?
I don't know. I see the yellow thing every time.
Yeah, well, it's not up. When I turned on my computer this morning, it wasn't there.
Yes, it was.
No, it wasn't. I actually looked because I said, crap, I forgot. So where's that orange button? And it wasn't there. It only pops up when you show up.
Hold on. Why are we not?
What's the matter? I'm good.
No, this bar at the bottom I want to get rid of.
Oh.
Not normally there. Just make white.
Now I'm good. There we go.
Now you're good.
All right, awesome. All right, get ready because Brian's is going to be in his button pushing happy day time when we get into this section. Okay, act like you're not going to push the buttons as soon as I say all these words. So as promised, we are going to start with derivatives. That's why I didn't want to get first couple of hours, we're going to run through the options, derivatives, and listen to Brian push his buttons. All right, so here we go. When we talk about derivatives, oh, he didn't do it. All right, so derivatives, rights, 2 times, that's it. Okay.
Try to be reasonable. I mean, I can push it all day, but I try to be reasonable. I've done it twice.
No, that's reasonable. That's reasonable. All right, so for derivatives, we have rights, we have warrants, we have puts and calls. Now, what are derivatives? What does that mean? That means that they derive their value from an underlying security. They derive their value from an underlying security. All right, so let's talk about that and what that means. So rights, we talked about rights yesterday. Remember, we have preemptive rights. And preemptive rights allows the common stock shareholder to maintain their proportionate share of ownership in the company. All right, that's preemptive right. What we're going to learn today about rights is that they're short term. Make a note, rights are short term. They can go out a max of 60 days. And they're going to be issued at a price below the current market value of the stock. So when we think rights, we think short term, max of 60 days, and they're sold below current market price. So with rights, you've got some choices, all right? You have 3 choices you can make with your rights. 1, you can exercise your rights. That means buy enough shares to maintain ownership percentage. 2, you can sell your rights. 3, you can let your rights expire. But whatever choice you make, it's going to be done within 60 days. The issuer will set the amount of days for the rights, but they will not be longer than 60 days. They have to be offered to pre-existing shareholders first. That's the preemptive right. This is what it looks like. This is Brian just put this together. Generic company, the right to buy common stock. Here he set it at 30 days. Remember, the max would be 60, but the issuer sets it. So for this one, generic company, they have 30 days to exercise, sell, or let their rights expire. It's going to be sold at a discount. The price right now is $100 a share. They're offering the rights at $95 at a discounted price, at a price below current market value. So short term and below current market value. And then we have warrants. Now with warrants, they're long-term, okay? Usually 3 to 5 years, but they can be perpetual. The issuer can set them up to go on forever. They're also issued at a price above the current market value, above the current market value. And the third bullet point, this word sweetener is going to matter. If you ever see the word sweetener on an exam, on a FINRA exam, they're directing you to warrants, right? Because generally, warrants are attached as a sweetener to a bond, and 99 times out of 100, it'll be attached to a bond on an exam question. But it could be attached to another security like preferred stock, okay? Now, the purpose of the warrant, okay? I'm going to give you kind of a description. Brian's going to give you how it actually works and work in the word sweetener so you understand what we're using. But the idea is that I'm an issuer and I need to raise money, okay? And I've decided that I'm going to offer a bond to raise money, okay? Now, you guys are bond brokers, people interested in bonds, and you like my company. You think my company could be the next Amazon. You think there's going to possibly be some growth in my company. All right. And so I need to borrow money. I need you guys to loan me the money. All right. But at the interest rate that I can afford, you guys want more. Right. And I can't do more. So what Brian's going to do is he's going to show you with numbers, well, with an example of how this would work in the real world. How can we get you to loan me that money that I need? So Brian, you're up.
Okay. So my company is coming out with a new bond, and we decided 7% is the most we can do. We went through, we looked at all of our numbers. That's what we can do. That's what we're going to do. You come back to me as professional bond and stock traders and go, listen, we like your company, but we need more than 7. With the economy, with the future, with everything looking, we need 7.2%. If you give us 7.2%, we'll buy your bond. We're not going to be able to buy a bond at 7%. I'm sitting there going like 7's the most I can do. I've done all the math. I can't afford to do anymore. But I want you to buy my bond. What if I had the warrant? You need more than 7%. You are offering basically for me to give you cash, annual cash. I can't afford to give you annual cash, Jeff. You're not muted. I can't. Hold on. Somebody else here. I don't know how people are unmuting. That's super weird. I think everything's good now. Okay. You need more than 7%. I can't afford to give it to you cash. What about this warrant? You already said you like my company. If my company goes up 50%, doubles in the next few years, that warrant's going to pay a heck of a lot more money than that extra 0.2% would. Did I sweeten the deal enough for you to now buy my 7% bond? Because right now, if you think about it, the warrant really isn't worth anything. It's a gamble. Because right now, let's say you could go anywhere you want and buy my stock for $100. And I'm giving you this special deal of buying it for $110. Always going to be worthwhile if the company goes to $150 or $200 because you can still buy it at that $110. So if my company goes up a lot, that warrant's going to pay out. It's a gamble. But I'm offering you a lot more return if you're now willing to accept the 7% and my company goes up. Did I sweeten the deal enough? Jeff?
All right. So here's a picture of generic company warrant. So remember, long term, Ryan has this one set at 5 years. You can go out forever. This one's set at 5 years, though. And the current price of the stock is at $100 a share. They're offering the warrant at $110, above current market value. All right, and now we go into options. Oh, he missed his cue. He's busy.
No! No!
There it is. All right. So we're going to start with options. Now, I think we do a pretty good job of breaking this stuff down, but it's going to be piece by piece. We're going to learn the basics. We're going to give you specific words that you need to write down in order, okay? It's very important. And the words that we use are going to be helpful for you to understand the concepts. The biggest challenge that we see with our people is we learned the basics wrong. And if you learn the basics wrong here, you're all messed up on the exam. So we have to make sure that we practice, drill, rehearse, right? We focus on the basics, which we're going to run through today. And then Brian is going to be very specific with his answers in the chat. We don't like answering why questions with options, right? Because there's a lot of whys right? And Brian's not scribbling on the screen for any other reason that he's fixing to tell another story. So he's preparing and I'm stalling. But he's going to tell this.
I still got to draw. Oh, that's not the right color for blood. Sorry.
No,
I got to draw the blood out. Oh, God.
You hear that blood? That's dried blood. That's kind of hard in the water, but that works.
Yep, I'm seeing. Well, there we go. That's a somewhat one.
Yeah, that's better.
The idea is, as I'm still clearly struggling a little quickly, I had some text to get back to, and that delayed my starting to draw. The idea is I'm trying to draw this beach here where we've got the nice sand, we've got the pretty little place where we can go and get our ankles wet, and I like to look at little clams and stuff dig, and little crabs run their little lives. But we see the sharks, and that's the sea monster. There's a sea monster right there. We can see them. They're right out there. But they don't come into the shallow water. That's the only place where we go on this test for options. I'm not going to tell you that options aren't terrifying. They certainly can be. I can give you a very real-world example involving a 20-year-old options trader who killed himself because he got in over his head. Not technically, but he's gotten stuff he really had no idea of what he was doing, clearly. These can be incredibly complicated and scary. In the real world, we're not in the real world, we're in test world, and they keep it in the nice little shallow parts. But you start asking why, and you start venturing out here to explore, that's where the sharks and sea monsters are. Options get very, very complicated very, very quickly. We don't get to those levels. So don't go there yourself. Jeff?
Thank you. All right. So we're going to start from the very beginning and work our way up. And again, Brian's going to be real specific on his answers when you start asking questions on options. So we want to have the questions, just like always. Give us the questions. Just be ready for very short answers, like he's not going to go into why this or why that much. Okay? All right, so here we go. We're focused on what we're going to be seeing on the exam. And it's not that bad. Not easy, right? But it's not that tough when you learn the basics. So options. What is an option? All an option is a contract. Okay? It's a piece of paper. And in that contract, every option contract is worth 100 shares. You know, there's 100 shares of the underlying security in a contract. So one contract equals 100 shares of the underlying security, which we'll explain. In this contract, there's two parties. We have buyers and we have writers. There's other names for them. And what I need you to do now, either mentally or physically, is I want you to draw a line down the middle between buyers and writers, okay? And when I tell you a term that goes with buyer, it only goes with buyer. When I give you a term that goes with writer, it only goes with writer. They never cross. Here's what I mean. The buyer. So this is on the buyer side, never to be used on the writer side. And this is extremely important from the very beginning. Here we go. The buyer is also known as the owner or the one that's long in the contract. So if we're talking about an option contract and you see the word long in an option contract, that means they're the buyer of the option contract. So owner, buyer, long. All right, we're not done. Only the owner has rights they can exercise. So in an option contract, who has rights? Only the buyer. The one that's long in the contract, the owner, has rights to exercise. They can choose to exercise their rights, or they can let their rights expire. But it's their decision. They're in control. The buyer of an option contract's in control. That's why when Brian and I teach this stuff, we focus always on what the buyer is doing, because if we know what the buyer is doing, we automatically know what the seller is going to do, has to do. Okay? So we don't have to remember both sides. We just remember what the buyer's doing, and we know what the seller does by default. All right. Now, if they exercise their right, they will force the writer to either buy from them or sell to them the security. Remember, owner's in charge. If they exercise their right, then the buyer is either going to be forced to buy the stock from them or sell the stock to them. So all of this is on the buyer side. The writer will never be the buyer, long, owner. Writer will never have rights that they can exercise, ever, ever, ever. As soon as you hear rights, they're talking about the buyer. They don't even have to say it. Now, when we go into writer, the writer, on the writer side, we have writer, and it's spelled W-R-I-T-E-R for a reason, because they write the contract. They physically write the contract. Then we have the seller, the one that's short in the contract. So we have writer, seller, short. They are the ones with the obligation. See, the writer is obligated. They are paid money to write the contract. So they're obligated. If an option is exercised, if the owner exercises their right, the seller is obligated to do whatever they're told. And that means either buy the stock from them or sell the stock to them. So when you see the word obligation, it's always the seller. Seller's always obligated. Writer is always obligated. The one that's short in the contract is always obligated. They cannot say no. When an option is exercised, the writer is obligated to do what they're told. They cannot say no. Here's some terminology. We know terminology is important through this whole exam, but when we're talking about terminology in options, we want to make sure we get them right. So the writer, again, writer is the seller, the one that has the obligation. We know the buyer is the owner, the one that's long in the contract. They actually, the ones who own the security, they're the one with the option to exercise and can force the writer to either buy or sell because the writer is obligated. And that brings us to the strike price. The strike price is the bet price. Okay, we're going to turn this over to Brian. He's going to explain strike price in zero-sum game and how that ties together with options. So, Brian, you're up.
Sorry,
Okay. Yeah.
Just to make sure, guys, right down here is the slide number. If you notice that there are two numbers on this on the pages in the middle, sort of, those are the slide numbers. The bottom is the page number in the notes. That's sort of weird. I'd look for the slide numbers. So you want to follow them. The idea of a, oops, someone, did I draw up there? That was me. The idea of a zero-sum game comes from math. I like math. It's a branch of mathematics called game theory that basically deals with the interactions between two or more people in the form of games. Now, a zero-sum game is one of, if not the largest sort of subcategory of games, to the point where if you and I were going to play a game, if you were going to pick a game for us to play, almost assuredly it would be a zero-sum game. They're just what most of us think of. A zero-sum game is one in which for you to win, you would have to beat me. Or for me to win, I'd have to beat you. For one of us to win, the other would have to lose. We can't both win. We can't both lose. We could tie. We'll come back to that in a bit. We could tie, but we can't both win and we can't both lose. That's how these options work. There's only two people involved, the buyer, the owner, and the writer, the original seller. That's it. Every dollar one makes is because the other is losing it. There's nobody else involved. Now, the idea of buying a put or buying a call, what you're doing is simply betting that a number is going to go up or a number is going to go down. What the number is, it doesn't necessarily matter at this point. Most cases, it's a stock price. That's a number, right? A stock price, $149.37. That's a number. We can bet if that number is going to go up or down. We could take 30 numbers, 30 stock prices, add them together. That's a number, right? I mean, if we add 30 numbers together, we're going to get a new number. If we take that new number and multiply it by some other number that we have, some other multiplier that we have, that's yet another number, right? If you multiply two numbers, we get another number. We can bet if that number is going to go up or down. I just explained how we bet on the Dow Jones Industrial Average. They take 30 stocks, add them together, do their Dow Jones multiplier. That's the Dow Jones Industrial Average. It's a number. We can bet on that going up or down. But the important thing, remember, with the bet between two people, if I am betting that a number is going to go up and you are taking that bet, you are not betting that the number is going to go down. You are betting that I am wrong. If I am betting that the Eagles are going to win by more than 7 points, you taking that bet, you're not betting the Eagles are going to lose. You're betting that they're not going to win by at least 7 points. You're betting that I am wrong. That's all these are. We're going to get back into that in a second. But the idea is the strike price is what we're betting. Is it going to go above that number or is it going to go below that number? I think I covered everything, Jeff.
Yep, sounds good. All right, now options don't go on forever, y'all. They expire, okay? And they expire on what is called the expiration date. That is the date that the option expires. It becomes worthless. So if you're the buyer, you want to exercise your right before expiration, okay? Because if you don't, it becomes worthless. You walk away, and the seller keeps the premium for writing the contract. Remember, the seller, the writer, gets a premium for writing the contract. They get paid money. All right, so let's go through here. Okay. All right.
You'll see it shortly. I think it'll work. I think it works nicely.
Okay. Let me know and I'll let you cover it.
Oh, you got it.
I got it. Okay. All right. So that's the expiration. So all options expire. We'll show you how that happens in an option quote here in a minute. Now, the premium. The premium is the cost of the contract. The buyer always pays the premium to the writer for writing the contract. Now, I want you to write this down. The only reason to write an option, is for the premium. Okay, that's the only reason. It's for the premium, the money, the income. So make sure you remember, the only reason to write an option is for the premium, the income. All right. Now, Brian mentioned in the zero-sum game, somebody's got to win, somebody's got to lose. In an option, we're betting on a strike price. Okay, we're betting on somebody bets it's going to go above, somebody bets it's going to go below or stay the same. All right. So someone's got to win and someone's got to lose. Well, or we could tie. Tie in an option is called break even. We're going to cover this in a different picture with the formula. It'll help you remember it better. So just remember, break even means tie. No one won, no one lost. Break even means tie. All right, so now we're going to break down the contracts. All right, and so Brian's going to be scribbling up here some words. We want you to write those words down exactly the way he gives them to you. So here we go. In a call contract. All right, in a call contract. Come on. All right. It's not go. Okay. It's really moving slow. Oh, nice. Okay. So in a call contract, the buyer of a call is the one in the contract that's betting the stock will go above the strike price. You can say it like this, and Brian put it up on the screen. Buyers call up. Okay. That's how we remember. Buyers call up because the buyer of a call is betting the stock price will go above the strike price. That's what they're betting. So the buyer of a call is said to be bullish because anytime you are the one in an option that's betting that the price is going to go above the strike price, then you're the one they call bullish because bulls attack up. Watch this. Moo. Snort, snort. Right. Bulls attack up. So the buyer of a call is bullish. But remember, you got to write it down exactly the way we give it to you. Buyers call up. It's not call up. Calls are not bullish. Buyer of a call. All right. Now the seller, the other side of this bet, believes it will stay the same or go down. So the writer, seller, they just think you're wrong. See, they don't care. They're going to win as long as the price of the stock does not go up. So the buyer's betting that it's going to go up. They're bullish. The seller doesn't care. As long as it doesn't go up, if it trades flat or goes down, seller wins. They're keeping the premium, the income to write the contract. So these are the three things that can happen in a call. So let's do it together. All right, now listen to the words we're going to use. The idea in the call is, okay, I'm going to be the buyer, you're the seller. We're going to have a $100 strike price. I'm the buyer of the call. Buyer calls up. I want the price to go up, and it does. It goes to $200 a share. So what I'm going to do, okay, what I'm going to do is I'm going to exercise my right, and I'm going to call the stock from the writer. Now, I am calling the stock from the writer. What do you think that means? Because when an option's exercised, somebody gets the stock and somebody gets the money, the strike price per share. If I am calling the stock from you, am I asking for money or am I asking for the stock? And the answer is, if I'm calling the stock from you, you are going to give me the stock. So in a call, buyer calls up, stock price goes up, I'm going to call those shares from you, and I'm going to give you the $100 a share. Now, you're not happy because the stock right now is selling for $200 a share. You have to give me 100 shares. I'm calling 100 shares from you, one contract. So you got to give me 100 shares of that stock selling for $200 a share, and I am going to give you the money, which is the strike price, $100 a share. So you lost. I win, you lose. Now, the other side of that is it trades flat or goes down. We're over here. So then the buyer is going to let their right expire. They're going to walk away. Seller keeps the premium. Seller wins. They keep the premium for writing the contract. So here's what it looks like. We just did a call. Buyer calls from the writer. So when a call is exercised, that means the buyer will get the stock because they're going to call the stock from the writer. And the writer will get the cash, which is the strike price. Okay? Only when an option's exercised, someone gets the stock, someone gets the strike price per share, the cash. In a call, the buyer calls the stock from the writer, so the buyer gets the stock, writer, seller gets the cash. All right, let's do puts. With a put, the buyer bets the stock will go down below the strike price. Buyer puts down. Buyer puts down. Whenever you're the one in a contract that thinks the stock's going to go down, you're the one they call bearish because bears attack down. So in a put, the buyer of the put wants the chart to look like this. We have a strike price. We're using $100 a share again. They want it to go all the way to zero. They want the stock to become worth zero. That's as low as it can go. But they want it to go down. The seller believes it'll stay the same or go up. In either case, as long as it doesn't go down, seller wins. So the way this works, buyer puts down. We have a strike price of $100. The price of the stock drops to $20 a share. So here's what's going to happen. The buyer of a put, okay, will exercise their right and put the stock to the seller. They're going to put the stock to the writer. Now, what does that mean? Well, that means that the writer is going to get the stock and I'm going to get the strike price per share. I get the cash. Now, you're not happy because I just put to you 100 shares of stock worth $20 a share, and you had to give me $100 a share for it. I win, you lose. Or it trades flat or goes up, in which case I, the buyer, will let my right expire. You keep the premium for writing the contract. So buyer calls up, buyer puts down, writer thinks they're wrong. They just think they're wrong. Some people learn it like, well, opposite. Well, if the buyer thinks it's going to go down, then the seller thinks it's going to go up. Well, not just up. What if it trades flat? They win there too. Oh, so they just think they're wrong. As long as it doesn't go down, the writer's happy. Now, I want you to write these two things down as well. Ready? Buyers always want the contract to exercise. So buyers want the contracts to exercise. Sellers want the contracts to expire. The only reason a seller writer writes a contract is for the premium. All right. So I want to go back to this picture and I want to do put. So put, buyer puts, when they exercise their right, buyer puts down. The buyer will put the stock to the writer. So in a put, when it's exercised, the writer gets the stock, the buyer gets the cash, which is the strike price per share. Keep that in mind. Buyer calls up, buyer puts down, writer thinks they're wrong. And those are your basics. Hopefully y'all wrote these 10 words down that Brian put up here. Buyer calls up, buyer puts down, writer thinks they're wrong. That'll answer a lot of basics for you, help eliminate answers. So here's a sample option quote. We have to learn how to read this. All right. Long 1 XYZ January 60 call at 3. And we have to know what does that mean. So we've broken it down for you. Long. The investor has bought the call and has the right to exercise the contract. Yeah, if you're long, you are the what? Buyer. So you bought the call. It says call right here. And who has rights to exercise? Buyers. So they have rights to exercise. All that for the word long. 1 XYZ. Okay? Okay, 1 XYZ. It's a single contract. How many shares in an option contract? 100 of XYZ stock. That would be called the underlying security. And then we have January. January is the expiration month. Remember, all options expire. And they expire on the 3rd Friday of the expiration month before midnight. In this case, January. If that said February, March, or April, whatever, it'd be the 3rd Friday in those months. So the contract expires on the 3rd Friday, January, before midnight, because this one has the expiration date of January. 60 is the strike price. When you're looking at an option quote, and we're gonna be doing multiple choice questions on this at the end of this section, the big number is going to be the strike price, and the little number is going to be the premium. All right, did you hear me? Big number is the strike price. Little number is the premium. That'll help you when you're reading quotes. This is a call contract because it says call. The type of option is a call, and the investor has the right to buy the stock at 60 because they're long in the call. Premium is 3. That means $3. How many shares in a contract? 100. So the premium of the contract in this example is $3 a share. Contract is issued with 100 shares. So the total premium that the buyer would pay the seller up front would be $300. That's the premium. And that's how you read an option quote. And we're going to be doing some of these at the end of this section. This is the simplest option chart. It gives you both the contracts, call and put, and then it has the buyer and the seller. I want you to write the other words that mean the same thing just so we don't forget. So write this in: owner and long. So owner, long, buyer. Owner, long, buyer. All right. And then for seller, we want to have writer, comma, short. So writer, short, seller. All right, so here we go. This is how you use Brian's 10 words to fill in the chart, which makes it very simple. Buyer calls up. Remember, buyer calls up. Buyer of a call is bullish. Bulls attack up. Snort. So buyer calls up. Writer thinks they're wrong. Seller thinks they're wrong. So if they're bullish, they've got to be bearish. Buyer calls up. Writer thinks they're wrong. Buyer puts down. Buyer of a put bets the put goes down, right? Buyer puts down. Price goes down. Seller thinks they're wrong. Buyer puts down. Seller thinks they're wrong. Now again, we have a lot of people, and when they're talking with me, they kind of shortcut things. Okay, Jeff, I know calls are bullish. Okay, calls are not bullish. Look at this. Seller of a call is not bullish. Buyer of a call is bullish. Buyer of a put is bearish. Puts are not bearish. Here's a bull right there. Makes sense? So you need to memorize this. You can do it easily with those 10 words. Here's some terminology. What I like to say using word association. What do I mean by that? Okay, market up. When the market's going up, we call that a bull market. If you want a bullish strategy, if you think the stock price is going to go up, then you want to buy a call or sell a put. Now here, when we're talking about long and short, we're talking about strategies of owning a stock. We're not talking about an option. So, for example, Brian is long Primerica. Okay? What long means when in stock ownership is that Brian owns Primerica stock. He's long Primerica. He owns Primerica stock, which makes him bullish on Primerica stock because he owns it. He's buying and holding. Buy low, sell high. That's the idea. That's a long strategy, and it's bullish. Market going down is a bear market. If you're bearish on a stock, if you're bearish, you want a bearish position in an option, you want to sell a call or buy a put. If you're using shorting a stock as a strategy, that's a bearish strategy because you're betting on the downward movement of the stock. So short here is a strategy of betting that the stock's going to go down and you can make money. So this long stock and short stock strategy, Brian's got a slide on that we're going to hit on a little bit later, okay, in a few more slides to go through strategy. Indexed or equity versus indexed options. This is a very simple concept. An equity option is where the underlying asset is just one equity security, typically a common stock. So here are two examples of an equity option. Ready? A call option on Primerica. Primerica would be the underlying asset. Only one common stock. Equity option. A put contract on Exxon. Again, Exxon would be the underlying asset. One common stock. That would be an equity option. An indexed option is where the underlying security is an index. We're betting on that number that Brian's talking about for the index. Examples of index options: a call contract on the Standard & Poor's 500 index, a put contract on the Dow Jones Industrial Average. Those would be equity options because the underlying asset is an index. Very simple. And then we're going to talk about the 2 reasons to purchase options. There's only there's 2 main reasons for purchasing options: hedging and speculation. And Brian's going to touch on both of these for us. So Brian, you're up.
The idea, let me grab my tablet over here. Hedging is insurance. Buying puts is insurance against long. If I bought the stock, I'm worried it's going to go down, so I would profit by buying a put. The idea is how you don't necessarily want it to go down. You don't want it to go down. But how would you make money if it did? You'd buy the put. In the same way that when you're selling life insurance to clients, I sure hope that when you're selling 20 or 30-year life insurance, they're not hoping to die in 20 or 30 years. That they're not buying it because they plan to die in 20 or 30 years. They plan to live until they're 90, 95, see their kids, their grandkids, maybe their great-grandkids grow up, have memories, travel the world, live their financially independent retirement. They're worried what happens if that doesn't happen. How would they, or I guess more accurately, their family profit if they should die? Again, it's not really profiting, it's stopping the loss. It's not losing as much as you otherwise might. There's still going to be loss involved. Similarly, if we're buying a call, when we're short, we're going to get into that, but when you're short, basically you're betting it's going to go down. So you're worried it might go up. So you would profit from it going up by buying calls. Now, what most people think options are for is speculating. They're not. Most are used for hedging. But speculating is gambling. Buying calls simply bet the stock is going to go up. Buying puts simply bet the stock is going to go down. Jeff has mentioned that I bought Primerica stock at about $85. Let's say I bought 100 shares. I wish, but let's just say to make these numbers easy. That means I invested $8,500. If the stock plummeted, fell all the way to, oh boy, $84.99, how much did I lose? Well, I lost a penny, but I had 100 shares. So, I lost $1, and I have $8,499 left. Not too bad, I guess. Lost a little bit. What if instead I bought $85 calls? And just to be clear, I don't mean I bought one call. I spent the $8,500 on calls. Now, last I looked, Primerica was at about 145. I think it's higher than that, but let's just say 145. That means I made $6,000 over here. I made $60 a share, 100 shares, $6,000. If I bought the calls and the same thing happened, just to be clear, make sure that we're hearing this, I would have made $6,000 over here. I'd have made between $4,000 and $100,000 over here. I don't know exactly where. My guess is somewhere between 60 and 90,000. 10 to 15 times. What happens though when it goes to $84.99? Well, I'm bought a call for $885 stock strike price. That's the word, strike price. He's not betting it's going to go above 85. Did it? Now, I'll give you that it was close. But as they say, close only counts in horseshoes and hand grenades. I always like adding nuclear weapons because, if they count in hand grenades, nuclear bombs, close counts too. But the idea here is if you go and put $8,500 on red 18 on a roulette wheel and it comes up black 17 and you're going, but I was close. Agreed, you were close. You were still wrong. And this goes to zero. You don't lose some of your investment when the options go bad. You lose all of it. I lost $1 over here. I lost 8,500 over here. Yeah, I made 6,000 over here. I made almost somewhere between 8 and 15 times as much over here. That's gambling. That's speculating. Simply betting that it's going to go up or down. $147, so I've made $6,200.
Woohoo!
As I said, I wish I bought the 100 shares. I didn't quite buy 100 shares.
All right, making money, making money. All right, good job on that. Let me just finish that up. So when we're talking about hedge, right? If you're long in a stock, you buy a put to hedge, protect, insure against a loss. If you're short in a stock, you would buy a call to protect, to hedge, for insurance, to protect against the loss as well. So this is your hedge. Long, buy a put. Short, buy a call for protection. All right, strike price. Strike price is the bet price of the option, the price a call buyer thinks it'll go above, and the price a put buyer thinks it'll go below. Again, that's why we want you to memorize these 10 words. Buyer calls up, buyer puts down, right? The strike price is the bet price. It will be the amount that changes hands when an option is exercised. Remember, when an option is exercised, and only when it's exercised, someone's getting the stock and someone's getting the money. The money would equal the strike price per share. All right, now we're going to learn about in and out of the money. In and out of the money is the idea of a contract being in or out of the money, meaning a call is either in or out of the money. A put could be in or out of the money. And how do you know when a call is in or out of the money or a put is in or out of the money? The way I like to say it is, if the contract is doing what the buyer wants, it's in the money. What does the buyer of a call want? Buyer calls up. They want the current market value of the stock to be above the strike price. That would be in the money for a call. Buyer puts down. So in the money for a put, what's the put buyer want? They want the price to be below the strike price. So as long as the price is below the strike price, a put is in the money because it's doing what the buyer wants. Brian likes to say, if the buyer's happy. What makes the buyer of a call happy? The current market value is above the strike price. Call's in the money. What makes a put buyer happy? Buyer puts down. The current market value of the stock is below the strike price. Puts in the money. Put buyer's happy. All right, another way to do it is with pictures. Remember, we like pictures. Here's another good one. Looks like there's a lot going on, but it's pretty simple. See, in a question about, and we're going to do some of these multiple choice questions at the end on in and out of the money, so pay attention. There's only 3 things that you have to know, and then when you look at the answer choices and it says in, out, or out the money, okay, then you're looking for 3 things in the question, only 3. Now, in and out of the money questions are notorious for distractions, throwing in things that do not matter. They look really important, but don't matter. All right, what are the 3 things we have to know? Write these down. We have to know the contract. That means, is it a put or a call? We have to know the current market value of the stock, which they have to state in the question, and the strike price, which they have to state in the question. Anything other than the contract, the current market value, and strike price is a distraction. It's a unicorn. It doesn't matter. Now, let's just make sure we're clear on how to read this. We have the greater than sign, less than sign. If we're in a situation where the current market value of the stock is greater than the strike price, so we have, let's say, $70 current market value, $60 strike price. Current market value greater than strike price. If it's a put, it's out of the money. If it's a call, it's in the money. If we have a question where the current market value is the same, it's equal to the strike price, like $50 current market value, $50 strike price, it's equal. If it's a put, it's in the money. The contract is in the money. And the call, I said in the money. When it's equal, the put would be at the money. And if it's a call, it would be at the money. And then if we have a situation where current market value is less than strike price, so we've got a $60 current market value and a $70 strike price. If it's a put, it would be in the money. If it's a call, it would be out of the money. This is all you need to know. Contract, current market value, strike price. Now you can figure the answer. Everything else would be a distraction. We'll practice. Don't worry. We've got it coming up. The term premium. Premium is the cost to purchase the contract. The buyer pays the premium to the writer. Tell me, what is the only reason to write an option? The premium. They might use income. Premium is the income. It's the cost to purchase the contract. Each option is 400 shares, so multiply the premium from dollars. They give it to you in dollars. Times 100 to find the true cost of the contract. Now, the premium consists of two parts. We have the intrinsic value. That's how much the contract is in the money. Remember, if a call contract, we have a call contract and the current market value of the stock is above the strike price, that contract's in the money. If we had numbers to this so you can understand intrinsic value, if we have a $30 strike price in a call and it's selling for $32, buyers call up, right? So it's $2 in the money. It would also mean it has $2 of intrinsic value. Now, the second part of this is called the time value. Brian's going to explain time value to you right now. So, Brian?
The idea here, let's say the current market value is $100. And I have a, what are we at? We're at April 90 call and a October 90 call. Okay. Do you think these both are going to cost the same? I mean, the fact I can buy it for 90, I can call for 90, and then I can immediately go and sell it for 100. They're both worth $10. So do you think that means that they're going to cost the same? No, the one that's good for a month, there's only a month. How much higher can that go? The one that's got 6 months and another month, I guess 7 months would be another way of saying that. The one that's 7 months, that one's got a lot more time that can go up. Could go down, agreed. Greater the risk, greater the return, but also make sure you never forget greater the risk, the greater the risk. But the idea of time value, the longer the time there is, the more valuable it's going to be. Maybe this April is $11 and October's $15. I don't know. I'm just making numbers up. But the October is going to cost more because there's more time. Similarly, what if we're looking at a October 90 put? I'm not betting that the stock's going to go below 90. It's currently at 100. Do you think that means that's free? No. It means it has no intrinsic value, but it's still got time. We don't know what's going to happen in 6 months. Maybe it costs a quarter. It's going to be cheap. Now, if in those 6 months, this company fell all the way to $89, it fell $11, 11%. That means I can go to the market, buy it for $89, and then put it to the writer for $90, and thus I make $1. Only $1? It fell 11%, and all I make is $1? I do want to point out that when you invested a quarter, that means that's 4 times your money. If this fell to 88, well, you're only getting $2, but that is 8 times your money. That is 800% return in 7 months. That's not too shabby. This lets me bring up The Big Short again. Jamie and Charlie, the two guys that were trying to work with Brad Pitt's character Ben, the way they made their money was through this process. As they explain it, how do they phrase it? When people don't think something's going to happen, they don't price it well. And when we're wrong, we lose small. When we're right, we win big. And if every time you're wrong, you lose a little bit, and every time you're right, you win a whole lot, and you're right enough, you too can turn a couple 100,000 into a couple 100 million like they did in a few years. I would argue it's a lot harder than they made it look, but it certainly is absolutely possible. Now, in that movie, what those characters were trying to go for, what they needed Brad Pitt's character's help with, Jeff, you're not muted, is that they were trying to get an ISDA. Now, what exactly that is doesn't really matter. What it would allow them to do, it's why they were going to these big, trying to get these desks, was it would let them sell leaps. I'll give you a guess as to which one of those acronyms I think is more likely to be tested. Yeah, it's not that one. That one is simply there to link to the movie. The idea with leaps are they are 3-year options. That is what they are. They are puts and calls that expire in 3 years. Most options expire in 9 months. These are 3 years. These are incredibly volatile. I mean, insanely volatile in certain cases. That's why they're not for retail. That's why they needed that is the license. That is the designation. But think about 2018, when people may have been trying to do these, buying their leaps. And they're looking at 2020, 2 years in the future. I mean, it's going to be a great year for business. I mean, all of these hotels are opening, all these new airplanes. I mean, 2020 is going to be a great year for tourism and travel and all of this. I mean, let's make sure we're investing in areas where 2020 is going to be good. I mean, that's what they may have thought in 2018 when they were buying these leaps. And then all of a sudden, 2020 happened. No one who was buying leaps 2 years before, 3 years before, had any clue that that could happen. These things are incredibly volatile. I think I covered that. Jeff?
All right, so underlying or cash settlement. So underlying settlement, again, simple concepts here. Underlying settlement is where the actual transfer of the underlying security occurs. All right, so in the examples we've been doing, right, calling the stock from or putting the stock to, we're actually settling with the actual shares of stock. If I'm in a call and buyer calls up and the stock goes up, I'm going to exercise my right, call the stock from the seller, okay? And that means they're going to sell me the stock. We settle with the underlying security. Now, most options settle with cash. They just determine the in-the-money position, which we just talked about, right? And whatever that dollar amount is, that's what they exchange for cash. They settle with cash, okay? So underlines when you settle with the actual security. Cash is obviously when you settle for cash. Indexed options must settle with cash, because if we did an indexed option, if I get a call contract on Standard & Poor's 500 index and buyer calls up and it goes up, I'm going to exercise my right. I'm going to be calling, right, that Standard & Poor's index from you. Well, here's the thing. They don't have shares. So I cannot call shares of the Standard & Poor's 500 index from you. We have to settle in cash. Covered and uncovered. Covered calls is when someone writes a call but also owns the same number of shares that they're writing. I want you to make a note here that writing a covered call, it is the most conservative option position. This is the most conservative option position. Let me give you an example. I own over 100 shares of Starbucks stock. I have made a decision to write a call on Starbucks, and I have the strike price set at $100 a share. No, I don't. I'll have it set at $80 a share. Let's do that. Have it set at $80 a share. All right. Now, Starbucks stock goes up to $100 a share. Oh, crap. So the buyer of that call is going to call, buyers call up. They're going to call 100 shares of Starbucks from me. I owe them 100 shares of Starbucks stock. Well, I'm not happy, but I already own some. So I hand them the 100 shares that I own. They give me the strike price per share, the $80 a share. That's a covered call because I was writing the same amount of shares that I own. Now, an uncovered or naked call. I need you to make a note here. This is the most risky option position. The most risky option position. Now, this is when someone writes a call, but they don't own the shares. All right, example, I do not own Exxon stock, but I've decided to write a call on Exxon. I set the strike price at $100 a share. Uh-oh, Exxon shoots up to $500. So Exxon shoots up to $500 a share. So the buyer calls 100 shares of Exxon stock from me. But guess what? I don't own Exxon, but I owe them 100 shares. So what do I have to do? I've got to go buy 100 shares of Exxon. What are they selling for right now? $500 a share. So I've got to go buy 100 shares at $500 a share and give it to you. In turn, you're going to give me $100 a share for it. Now, when you write an uncovered call or a naked call, you have unlimited risk potential. And the reason is because how high can the price of a stock go? Usually Buzz Lightyear would come in and say to infinity and beyond. All right? It can go up forever. So when we say you have unlimited loss potential, that means you could lose everything. And when we say everything, literally they can come after your house, your cars. Okay? There's no joke. I mean, they can come at, they're going to get their 100 shares of Exxon stock, or they're going to get the dollar value for it, but they're going to get it from you. So you have unlimited loss potential when writing an uncovered or naked call. It is the most risky option position. There's two types of options. We have American style options and we have European style options. In the American style option, it can only be exercised. It can be exercised anytime once we started the contract before expiration. So you could start the contract today and you could exercise tomorrow or any day until it expires. The difference between an American and European option is you can only exercise a European style option on the expiration date, not before. So that's a big deal. Most options are American style. If they ask about any other type of option, early on when Brian and I were teaching this last year, we were having people talk to us about Asian style options, African style options. Okay, those don't exist. There's no such thing. So those are either unicorns in the question, wrong answers, but you only have American or European. All right. The terms exercise and assignment. All right. This is stuff that we're learning. Okay. This is what we're saying is that the buyer has rights that they can exercise. Okay. Buyers have rights that they can exercise and force the writer to assignment. That means do what they're told. The writer has an obligation of assignment, meaning if an option is exercised, the writer is obligated to do what they're told, either buy the stock from or sell the stock to. And that leads us to strategies. And Brian's going to talk about strategies. So Brian, you're up.
So the idea of the first strategy of going long, you want to purchase, you want to buy low and sell high. You always want to buy low and sell high. You never want to buy high and sell low. That's how you lose money. You want to buy low and sell high. But what if we could switch that around a bit? I don't mean buying high and selling low. That's how you lose money. Always buy low, sell high. Buy low, sell high. But what if we could sell it high and then buy it low? That's the idea of shorting. Wanting to borrow the security, selling it for cash now, and then later buying it when it's gone down and returning it plus some interest, because that's why the person lent it to you, and you get to keep the difference as your profit. What do I mean? Well, I believe that ABC is going to go down in value. So I end up finding a sucker, Jeff, who has 100 shares of ABC, and he's going to lend them to me. They're each worth $100, so I now sell them, and I have $10,000 in my pocket. A few months later, it turns out that I'm right. ABC goes down to $80. So I take that $10,000 and I go and buy 100 shares at the $80. So I have I spend $8,000. I have $2,000 in my pocket. 1 second. And the 100 shares. Remember, I owe Jeff 100 shares. I don't owe him $10,000. I owe him 100 shares of stock. I now have 100 shares of stock. So I go and return the 100 shares that I borrowed. I give him some of the interest as why he did this, and I get to keep the difference as profit. Thus, I sold it high and later bought it low. Now, there's certainly some real-world stories that we need to get into to help get through this. But the idea is I could have been wrong, and this could have gone up. Now, as we say, how high can it go?
To infinity and beyond.
Well, it really can't. Infinity's not a number. It can't go that. But it certainly could go to any price that any other stock's gone to. Let's pick one, I don't know, totally at random. Definitely a random stock to pick when we're looking for stock price. When we started, it was 264. It's gone down a little, Jeff. It's now 388, a little bit below. It's $5 short of 388, it looks like. So, just in case they should put that, I can clear this one up and write the full one over here. Where is it? Here it is. Just so that we get the joke. Doesn't have sense. Sometimes it has sense. That is $387,000 for one single share. That would mean it certainly could go to Berkshire levels. I would need almost $39 million to buy those 100 shares I owe Jeff. Now, the way this works in the real world, as it goes up, I'm going to be asked to put in more collateral. They're not going to let me get to owing $38.8 million when I've got $10,000 that they know of. They're not going to, as it goes up, I'm going to owe more money. Now, it could go up for all kinds of reasons. There's a rally behind ABC. Maybe there's a whole bunch of people that have fond memories of ABC. They remember going there as a kid and they want to start buying it. Or maybe they just really, really hate me. And they know that I have to buy back ABC at some point. So they're just going and buying ABC, not because they like ABC, not because they think it's valuable, but because they know if they buy it, it's going to cause the price to go up, and that's going to really screw me. Because as the price goes up, I have to make more collateral deposits. I believe the total was close to $30 billion is what the hedge funds lost due to the GameStop short. Because they went and they shorted the GameStop. They made their announcement, which was stupid. And a bunch of people who really, really hated them, led by someone who may or may not have done it based on hating them. We'll see what the SEC verdict is when that comes down. Caused the price to go up and cost me a lot of money. But the idea is shorting is a useful part of the business. It helps. It's investigations. It helps people find bad companies. These people go, they do the investigation, they find the companies that are bad, and they bet against it. And if they're right, they make money. The problem is when you do it based on greed and then brag about it, that's what gives short selling a very bad reputation. Short selling on its own is not bad. Anything can be done badly. It isn't inherently bad. There are entire businesses that do this. I don't need to find Jeff to necessarily short. I talk to my broker dealer. They'll find someone who's willing to lend it to me. But I think I answered anything here. Any questions. This is where you want to ask your GameStop questions, folks. Anybody got any questions, or are we good here? Wow. Okay. Normally there's a lot more questions.
You up?
You want me to go through this one too? That's
Well,
right. I go through this one. I forgot. New pictures that we've added here. The idea, because this one needs a slight bit of explanation beforehand. Forgot, Jeff. Let's talk about now. Whenever now might be, I have no interest in a company. None. I don't care if it goes up. I don't care if it goes down. I have no interest. At some point in the far, far future, I also, no interest, don't care, go up or go down, no interest, no investment, no bet whatsoever. But at some point in the future, I do have a bet. Now, I'm not saying I'm betting it's going to go up or I'm betting it's going to go down. I'm just saying I am betting on this stock. Now, what that means is some point between after now and before the far, far future, I had to buy and sell this stock. What we need to make sure we remember, though, is that the order of that doesn't matter. I could have sold and then bought it. I could have in the future be betting it's going to go down. I could have shorted it. I could be betting it's going to go up. I could have gone long. Not saying which one it is. Don't know. Don't care. All that means is I bought and sold it. Now, if whatever the first thing you do, you open the position. If the first thing you did was buy, you're opening a long position. If you open sold, if you had a sell to open, that means you were starting and opening a short position. The first thing I did when I was borrowing from Jeff, was I sold it. If the choice is buy or sell, borrow is not one of them. I borrowed it, but then I sold it. The first thing I did was sell it. To get out of a position, to hopefully collect your winnings or stop losing, you have to close the position. It's just the opposite of what you did to open. If I bought it, I have to sell it. If I sold it, I now have to buy it to replace it. So you want to make sure that you recognize that. I've got a lot of people who come and get confused on what is it opening to sell? How do you open to sell? You establish a short position. That's what open to sell means. Perfectly legitimate, perfectly fine. Just weird because it's not something we normally think of.
All right, so Options Clearing Corporation, the OCC. They help clear and settle options. Okay, we're going to talk about clearing and settlement here in a little bit. And then the OCC creates the option disclosure document, the ODD. So it's a publication of the Options Clearing Corporation that must be read to first-time option traders before making trades. And the reason is because of all the risk. It's extremely risky investing in options. All right. And that gets us to this page. This is another one of those pictures that we would like for you to be able to recreate on your Einstein sheet. Now, again, we're just making strong recommendations. We talked about yesterday the bond teeter-totter. We'd like you to have that. We'd like you to have this. This will help you answer most of your option questions. So if you can memorize this, you're in great shape. What we're going to do is we're going to use this picture to go through a lot of multiple choice questions. Let me just touch on what we're looking at. So anytime you get a question, a multiple choice question on options that's asking about max gain, max loss, or break even, this is the chart you're going to use. There's only 4 option positions that you can be in. You can either buy a call, sell a call, buy a put, or sell a put. when you're looking at these multiple choice questions, the first thing you do is identify what option position is the client in. Then you look at what are they asking, max gain, max loss, break even. So for example, if they're writing a call and they want to know your max loss, then you go max loss, writing a call. Well, that's unlimited. So by having this picture down, you can easily come up with the answers. So let's take a shot at it. Got to move Mr. Brian out of my way. Okay, now let's try this. We are all prepared today, Brian. Good job. All right, so here we go. A client who purchased one TSG 50 call at 4. What is the maximum loss this investor could face? All right, they want max loss. That's on this picture. So first we have to determine what position are they in. Are they buying a call, selling a call? Brian?
Real quick, Jeff. We had someone say, so when we get to testing, we should recreate this chart. I explained that you have two options with this chart. You can either memorize it, or you can get it tattooed on the inside of your eyelids. Tattoo parlors are open, so it's a possibility. And with a bright enough light, you might be able to see it. You got focal distance, and you got to compensate for that and infection. It's a risk on that. I'd recommend the memorizing it, but you do have a choice. Either way, yeah, you want to make sure you have this chart with you.
All right. Did he stress the importance? Now look, you can't bring it in with you. Just so everybody's clear. You've got to recreate it once you start the exam. All right. But it will be extremely helpful if you do that. Okay. So the first thing we have to do is determine what position are they in. Well, this person purchased a call. All right, if you purchased a call, are you buying the call? Or are you selling the call if you purchased? Well, purchase means buy, right? Okay, so we're buying the call. So we're right here. They want max loss. So buy call, max loss is the premium paid. We look at our chart. Remember, we're stressing this. The big number is the strike price. The little number is the premium. We want to know the premium paid, so we come up here to $4 premium. Remember, that's $4. There's one contract. How many shares in a contract? 100. 4 times 100 is going to give us $400. If you want to, you can screenshot this. Right, here's your explanation, and then we'll go to the next point. All right. Here we go. A client is long one TSG 75 call at 10. What is the maximum gain this client can face or could make? All right. Max gain is on here. So we need to find out, okay, what position are they in? All right. This one's easy because it tells us long call. So they're in the long call. They're right here. We want max gain, long call, unlimited. That's right. Long call. You're buying a call. How high can the price of a stock go? Unlimited. I'm going to give you a second to screenshot that if you'd like. All right. An investor who purchased a BMK 30 call at 5 when BMK was trading at 32 has what price as break even? Okay, they want break even. Break even's on this chart. So we've got to locate the position. What position is this person in? All right, they purchased a call. All right, purchase a call means they bought the call. They're buyer long in the call. They're right here. And we want to know break even, which is strike price plus the premium. Well, remember, big numbers the strike price, little numbers the premium. But wait a minute. It says BMK was trading at 32. Okay, well, trading at 32 means it's currently selling for it. Current market price is 32. Do we need anything about current market price here for this to determine break even? No, we just need the strike price and the premium. Okay, then it's simple. $30 strike price plus a $5 premium gives us $35. And here's your explanation. Strike price is 30, premium is 5. See, the 32, selling for 32, that was the unicorn in the question, right? That was the distraction. We did not need to know that to answer this question. A client is long one TSG 75 put at 10. What is the max gain this client could make? Okay, max gain. Max gain's on this chart, so we want to find the position. This will help us. They're in the long put position. Long put, so they're right here. They want max gain. That's going to be strike price minus premium. Strike price minus premium. Strike price is the big number. Premium is the little number. So 75 minus 10 is 65 times 100, because one contract is 100 shares, gives us 6,500 is our answer. A client who purchased one TSG 50 put at 4. All right. What is the maximum loss this investor could face? Max loss is on this page. So what position are they in? What position are they in? They purchased a put. Bought a put. And they want to know max loss. That's premium paid. Big numbers the strike price, little numbers the premium. $4 times 100 equals $400. So hopefully you're catching on. The idea is if you can recreate that chart, and look, you're going to be practicing, drilling, rehearsing all through Kaplan, man. Set up questions for these options. Have that chart out. If it's about max gain, max loss, or break even, use that chart. The more you use it, the more you're going to be able to recreate it. So when a question comes up, you'll just have the answer in front of you, which would be awesome. Oh, look at this one. Oh, they went in and out of the money. All right. So we got to come up with a different picture, don't we? That's why you want to have both of these out, because you don't know what they're going to ask you in an option. All right. So there you go. So here's the picture. Do you remember the 3 things I had you write down when you have an in, at, or out of the money question? What are the 3 things that you need to know, and everything else is a distraction? Do you remember? The contract, put or a call, current market value, strike price. That's it. Anything other than that's going to be a distraction, a unicorn. All right, let's give it a shot. What would be the best way to describe a short JDT 80 put at 8 and the current market value of JDT is 75? All right. Short JDT 80 put at 8, current market value 75. Is the contract in the money, at the money, out of the money, at parity? All right. Well, we know it's a put contract. We need the current market value. It is 75. We need the strike price. That's 80. That's all we need. So do we need to know if the client is short or long in the position? No, we don't. In this question, that's a distraction. That's a unicorn. It doesn't matter short or long. This is the premium. Do we need to know the premium? Nope, premium's not on here anywhere. So the premium also a distraction, a unicorn. Get a lot of unicorns in and out of the money questions. So we know what we need to know. Let's apply it now. All right, if $75 current market value is less than an $80 strike price, right? $70 current market value is less than an $80 strike price. So we are on this line right here. This is a put contract. So this put is in the money. The put is in the money. Very simple when you're learning with the picture. Boom. There you go. We'll let you take a second, take a snapshot at this. All right, here's another one. What would be the best way to describe a short JDT 80 call at 8 and the current market value of JDT is 85? Excuse me. Okay, what do we need to know? Number one, it's a call contract. Number two, we need current market value, 85. Number three, we need strike price, 80. That's all I need. Do I need to know if they're short or long? No. Unicorn. Do I need to know the premium? No. Unicorn. Distraction. All right, let's put it to work then. Now we have a current market value at 85 with a strike price of 80. We're on this line. And it is a call contract. So current market value of 85 is greater than a strike price of 80. It is a call contract. So this call is in the money. Okay, they want break even. Oh, break even? Okay, that's the other picture. An investor who purchased a BMK 30 put at 5 when BMK was trading at 28 has what price as break even? Okay, they want break even. That's on this picture. So we have the right picture up. We need to determine the position next. Purchased a put. They're long put. They purchased a put. They're right here, and we want break even. So we need strike price minus premium. Strike price minus premium. Well, we know strike price is the big number. Premium is the small number, but there's 28. Okay, well, what does that mean? Well, BMK was trading at 28. Okay, that's the current market value is 28. That is a unicorn in this question. We do not need current market value in this question. We need to know the strike price minus the premium. We know the strike price is the big number, 30, minus the premium of $5. That's going to give us an answer of $25. And there's your answer. The fact that it was trading at 28 was a unicorn in the question, a distraction. We did not need to know that to answer this question. Okay, we're back to in and out of the money. How would you describe a BMK 65 call at 7 when the current market value of BMK is 58? Well, it's a call contract. We need to know what contract it is. We know we have a current market value at 58 and a strike price of 65. We know we don't need the premium. That's our distractor. That's the unicorn. So let's figure this out. Looks like we have a current market value of 58 is less than the strike price of 65. And this is a call. So this call is out of the money. Remember, buyers call up. For this to be in the money, we need a number greater than 65. We don't have it, so this contract is out of the money. Buyer calls up. Okay, this is a bad bet for this buyer. How would you describe a BMK 65 put at 7? And the current market value of BMK is 72. All right, we need to know 3 things. We know it's a put, so we're over here. We need to know the current market value, 72. And the strike price is 65. So we have a current market value that is greater than the strike price. So we're on this line. So this put, let's see. Oh, sorry, I'm messing this up. Current market value is 72, which is greater than the strike price. So current market value 72 is greater than the strike price at 65. So we're here. This is a put, so it's out of the money. Remember, buyer puts down. They need the price, the current market value, to be below the strike price. So this is a bad bet. It's out of the money. There's no intrinsic value. All right. A client purchased one TSG 85 call at $8.64 when the current market value is 85. What is the best way to describe this position? I like how Brian throws in $8.64 because that will distract us. It's like, what the heck? Okay, that's the premium. The premium in an in or at or out of the money question is a distraction. It's a unicorn. It doesn't matter. We need to know that it's a call. We need to know that the current market value is 85 and the strike price is 85. Well, that's equal, so let's give that a shot. Current market value 85 is equal to strike price of 85. So we're right here on this line. This is a call contract. This call is at the money. At the money. And when a contract is at the money, there is no intrinsic value. Remember, you only have intrinsic value when the contract's in the money. And that intrinsic value is going to be equal to how much it's in the money. So a call contract with a $30 strike price selling for $32, $2 in the money if it's a call contract. This is at the money, no intrinsic value. And then the last one. A client purchased one TSG 85 put at $8.64 when the current market value is 85. What is the best description for this position? What is the best description for this position? Well, we know it's a put. We're over here. And it looks like we have a current market value at 85 and a strike price at 85. So again, current market value 85, strike price 85. It is a put. So the put is at the money. All right, Mr. Brian, we got to our first break, sir.
He keeps forgetting. So this is where we're going to be going. When we come back, we're going to be resuming where we left yesterday. Let me take people off of... See if there's any questions here, so people can publicly chat again. When you say, when people say, is the strike price always the larger number or the smaller number? Well, there's sometimes three numbers. You got to read the question. The strike price is going to be very close to where it says call. When they say at, that's a price. If you can get 75 apples at $3, which is the price, which is the number of apples, which is the description of the apples. If it was, you can get 30 apples at 80, again, at 80 is going to be the price. It doesn't really matter, smaller or larger. You want to read the questions there. Intrinsic value is when it is in the money. As it was explained yesterday several times, and today, I think twice already, you will be able to purchase a replay of the class. It will not be emailed. Parity is a meaningless concept that Kaplan really likes asking about. Parity is when there is zero time value. It is not a real life situation. It doesn't occur in the real world because there's always time value. When the premium equals intrinsic value is parity, but don't worry about that for the test. Any other questions? Okay. Oops, need a bit. I'm not starting stat. Uh-oh. My stat stopped working, Jeff. Keeps breaking. Bang. See if that works. Hey, there it goes. 17 minutes. We'll see you guys back then.
All righty. Gotta love it. All right. Moving right along. Communications with the public. Retail communications. Advertisements are a type of retail communications. Advertisements would be materials used in the media like newspaper, magazines, radio, television, billboards, websites. These are advertisements. Investment companies, broker-dealers cannot make any guarantees or promises in these advertisements. And they're going to need principal pre-approval. Okay, if it's going out to the public, principal pre-approval, an exception to this is going to be your institutional communications, because institutional communications are just communications between two broker-dealers, mutual funds, things like that. So like Merrill Lynch talking to Smith Barney. FINRA doesn't really care too much about what Merrill Lynch has to say to Smith Barney in a institutional communication. What they do care about a lot is what Merrill Lynch and Smith Barney have to say to you, the retail customer. So there's no principal pre-approval needed on institution communications. Sales literature. Sales literature is defined as any written or electronic communication that's made generally available to the public. Okay, we work with a lot of different mutual fund companies, right? And they have some really nice sales literature, right? And they give that to us for free so that we will hand that out to our potential clients, to our market, to get them to do what? Buy something, right? Hence the name sales literature. Reprints, telemarketing scripts would also be included in the definition of sales literature. And then we need to learn some numbers, and these numbers are getting tested. So a retail communication. Okay, retail communications, these are distributed to more than 25 retail investors in a 30 calendar day period. So more than 25 in a 30 calendar day period. All right, so with communications, they could say it like this. XYZ brokerage firm sent out 10 communications a week for 4 weeks. 10 communications a week for 4 weeks, that's 40. 40 is more than 25, so that would be deemed a retail communication. Retail communications need principal pre-approval. So communications versus correspondence. So we just talked about communication. Here we go again. Communication is sent to more than 25 in a 30 calendar day period, and it will need, communications will need principal pre-approval. Correspondence, on the other hand, is sent to 25 or less. 25 or less in the same 30 calendar day period, and the principal only needs spot checks on correspondence. They're going to need principal pre-approval before a client sees communications. You need to know this information. Advertising and sales literature approval, record keeping, and filing requirements. We've already talked about broker-dealer rules for advertisements and sales literature. It's got to be kept on file for 3 years. Advertisements and sales literature must be filed with FINRA within 10 days after use. Now, this is for established firms. For established firms. If it's a newly established firm, right, they've got to get the sales literature. They got to get everything to FINRA first. Here's a slide that'll show you the breakdown. Advertisement's going to be created. The principal's going to check it. If you're an established firm, established means a company that's been in business over 1 year. So PFS Investments, Merrill Lynch, Smith Barney, Goldman Sachs, these are all established firms. All right. So for an established firm, it can go right to the client after the principal checks it. But within 10 days, it's got to be sent to FINRA. If you're newly established, that means the company's been open 1 year or less. The ad's created, principal checks it. It got to go to FINRA first and then to the customer. And then suitability requirements. Suitability, what falls under suitability is know your customer. All right. And so KYC, we have to know certain things about our client or we cannot open an account for them. Okay. And you'll be tested on this stuff. So what do we have to know? Well, FinCEN, Financial Crime Enforcement Network, they're going to handle the bank and anti-money laundering regulations. But for us as a registered rep, we cannot open an account for a client if we cannot identify they are who they say they are. We have to have proof of identity. We have to be able to verify their name, their address, and whether they're of legal age. If we cannot determine those three things, we cannot open the account, right? And so what documentation is legitimate? U.S. government picture ID that's not expired. So U.S. military ID, U.S. passport, U.S. driver's license, U.S. or state-issued ID card, permanent resident card, any of those would work. And you, the registered rep, sign off saying you saw those documents. So what constitutes making a recommendation? Well, the general requirement is we have to have a reasonable basis to believe that the investment is suitable for the customer. How do we do that? We ask questions. We ask a lot of questions, okay? And they're called investment profile questionnaires. Brian's got like 3 different company questionnaires that he can pull up. Could you have time to do that?
I mean, we can. I mean, the issue is that a lot of times I think students are asking questions about it. Excuse me. You guys can easily do a Google search for like investment questionnaires, investment risk tolerance profiles, and see samples. They're all going to basically be the same. How long until you need to use this money? How long do you want the money to last? What would you do if the market suddenly dropped? What would you do if the market dropped again? Would you like an investment that has a low bit of return and low bit of risk, or a higher bit of return but a higher bit of risk? somewhere in between? What are your thoughts on inflation? All those kinds of things. What's your experience in the market? What's your income stability? Those kinds of questions. They're all going to be basically the same across them. And you add up the score, because depending on how they answer, because it's multiple choice, they get like a 1, 2, 3, or 4, or 5. And then you get basically, as we say, circles or donuts, which are just circles with the missing center. That are broken down into those pie charts, basically, of what they should be invested in. So you go and ask the people these questions, you add up their score, and it tells you what they should do. It's super simple in the real world. Test makes it look hard. It's really easy in the real world.
Yeah, so for us, we have 7. So for PFS Investments, we have 7 mutual fund suitability questions. Okay? There's only 7. But they're going to talk about your time horizon, what are your long-term goals and expectations, and short-term risk attitudes. Those are the 3 categories that we have, like 2 from this and 3 from that. But that's it. It's just like 7 questions. And again, the questions aren't so important, right? But when we get the questions answered, then it gives us the little circles or donuts, right? And that's your portfolio. In the real world, determining suitability is easy because it is asking for mutual funds. It's asking those questions, totaling up a score, and that gives us your portfolio. So what do we need to ask? We ask like things like age, investment history. What are your objectives, right? Short-term, long-term. What's your risk tolerance? How can you, how do you stomach a negative rate of return on your investment for, 6 months or over a year, and so with this information that we get, it helps us determine a profile. All right. Only a total idiot would recommend blue chips. Everybody knows yellow chips taste better in salsa. I agree with that, by the way. All right. Associated persons. So a registered person is basically a licensed rep under FINRA, right? You will become a registered rep. So who is a registered person? What is a registered person? Registered person is anyone in a firm's investment banking securities business, and they must be registered representatives with FINRA. That's an RR. That's what you're going to become. You'll be an RR when you pass your Series 6. So that's a registered person, means licensed. The duties of a registered person, all right, include supervision, soliciting, training other associated persons with the member. A registered rep can handle customer accounts. They can make recommendations. Okay, they can pay commissions, be paid commissions. They can split commissions with other registered reps from the same broker-dealer. And then we talk about a non-registered person. Well, a non-registered person, someone that does not have a license, right? So they're going to be limited to clerical, administrative, or janitorial type positions. They may not recommend or solicit business. They cannot be paid commissions on any securities business. And then we have background checks. With background checks, the firm is responsible for investigating the good character and business reputation of a person that they're looking to bring on board. One way they can determine that or help determine that is looking at the most current U5. The U5 form is a withdrawal form. When a registered rep leaves, either quits or they got terminated, whatever, when they leave one broker-dealer, the broker-dealer files a U5 form. It's a withdrawal form. Now, I look at it like a resume. If you're going somewhere else to another broker, they want to see the U5 because it tells the good, the bad, and the ugly about you. Are there any customer complaints? What states are your license in? What products do you can, it goes into this kind of stuff in the U5. Also, they have to go back 10 years employment history. 10-year employment history. They go back. Well, some of you guys might have been in elementary school. Doesn't matter. You have to list it. List it as student. Fingerprinting. All right. Everyone in the business gets fingerprinted. So anyone that's a registered rep, that's going to be you. So you're going to be fingerprinted. And this always comes up. I just passed my life test and I had to get fingerprints for my life test. Do I still need to get fingerprints for FINRA? Yes. Everybody wants your fingerprints. So you will have your fingerprints done there are exemptions, like who wouldn't need to have fingerprints done? If you don't handle money, if you don't have access to cash or securities, if you do not supervise any employees that engage in those activities, then you would not be required to have fingerprints done. But you, all of us in here, we're going to have fingerprints, right? We have to become a registered rep. And then we have statutory disqualification. Okay, that's not a good thing. That's a bad thing. It's abbreviated SD on the test, SD, but statutory disqualified means you've been disqualified. You cannot get a securities license for some reason. So the fancy definition is here, right? If a person is expelled or suspended or is denied trading privileges or subject to an order by the Securities Exchange Commission, okay, that's the definition of being statutory disqualified. What would cause a business, a company, a firm to be statutory disqualified? Well, if they've been expelled or suspended by another SRO, you get kicked out of the CBOE, Chicago Board of Options Exchange. Do you think FINRA is going to open up their arms and welcome you in? Probably not. You are now subject to an SEC order denying, suspending, or revoking your license. Yeah, if the SEC takes away your license, you're going to be disqualified. You're not getting into another broker deal. If you willfully filed false and misleading membership application, so the company lies on their application, that can get them SD'd. And then I want you to add this bullet point. This is being tested lately, so I need you to get this. Ready? Listen up. For a company can be statutory disqualified solely for lack of experience. And there's not like, well, you got to have 2 years experience. If FINRA says the company has lack of experience, they can disqualify them. So a company can be disqualified solely for lack of experience. That can absolutely happen. And you need to know that, and it's been tested recently. Now, for an individual, what would keep an individual from getting a securities license? Brian, what are you drinking? Is that a jug? Jeez. Come off of mute because I can't hear you. I want to know what that is.
It's Green Goodness. It's from Bolt House. What is it? It's a fruit drink smoothie.
Okay.
It's got a kiwi, apple, mango. It's got 3 apples, 1 pineapple, 4 mangoes, one and a third bananas, and 1 kiwi.
Yeah. Okay, it looked like it was in a gallon jug. That's what I was concerned about.
It is. I drink it for a while. Go ahead.
All right. Sounds good.
It's cheaper when you get it in the bigger bottles.
Good point. All right, back to work. All right, so what would keep an individual from getting a securities license? Well, what if they made willful misrepresentations on the registration? Your registration form is a U4. So you willfully misrepresent on your U4 or you outright lie, that can get you disqualified. If you have a felony conviction in the past 10 years, that can get you disqualified. And again, felony conviction, not felony charges. We have to report felony charges, but you can't get statutory disqualified unless it becomes a conviction. Same thing with misdemeanor. It has to be a misdemeanor conviction, but it's more specific. Misdemeanor conviction, but it has to involve securities or money. If you bounced a check at Walmart, never cleared it up, and it turned into misdemeanor charges, that would be a problem because it involves money. If you have a misdemeanor conviction for drunken disorderly conduct, that wouldn't get you SD'd. Got to report it, but wouldn't get you SD'd. All right, and then I need you to add this bullet point, and this has been tested. All right, ready? For an individual cannot be disqualified solely for lack of experience. So if the only thing holding you back from becoming a registered rep is lack of experience, that can't hold you back. All right, so for an individual, they cannot be disqualified solely for lack of experience. All right. Want to make sure you got that because it's going to matter. Failing to register an associated person. What we're talking about here is that a broker-dealer, a member firm, has placed an employee in a position where they should be licensed, registered, and they're not. So the broker-dealer has placed this person in charge of supervising these associated persons / registered reps. They need a license. They don't have one. This would be deemed conduct inconsistent with just and equitable principles of trade. And they will face the appropriate disciplinary action. They could be fined, suspended. Reportable activities. Private securities transaction. All right. A private securities transaction is when a registered rep is selling a security that their broker does not offer. Registered rep is selling a securities product that their broker does not offer. All right. Now, to do this, they must get prior written permission, and the trade's got to run through their broker-dealer's books. Then it's legit. So a registered rep is selling a securities product that their broker doesn't offer. As long as they get prior written permission and they run the trade through their broker's books, we're good. No challenge. Now, the violation of a private securities transaction is called selling away. If we don't sell it, you can't sell it. See, registered reps can't sell securities products that their broker doesn't offer. If they do, that's selling away. That's a violation. That's bad. Well, people say, well, selling away is okay if you get prior written permission. Yeah, no. Selling away is the violation. It's always bad. Now, if you get prior written permission and run the trade through the broker's books, that's private securities transaction. The violation is called selling away. Selling away is always bad. Outside business activity. This is known as an OBA. This is where we have to notify our broker-dealer of any outside income that we have coming in from outside of the broker. Examples of this, we have a lot of this in Primerica because most of the reps that are join Primerica are not full-time. They have full and part-time jobs. When I joined and I was going to get my securities license, I was in the restaurant business. I had to report that I had, that I was the manager of Alamo Cafe. I was not asking permission to keep my full-time job because I don't sell securities, right? I was in the restaurant business. But I had to let them know that I had outside income. If you drive Uber full-time or Uber part-time, right, you make income from other sources. It just has to be disclosed. That's it. That's an OBA. Gifts and entertainment. Broker-dealers may not pay compensation to employees of other member firms unless the employing firm gives written permission. Again, see that word written must be in writing, or if it's a gift value just under $100. So if you have a $100 gift, we're good. All of the companies that we work with, all the investment companies, all the mutual fund companies, all the annuity companies, they're all allowed to give you literally a $100 gift every year. They can't give you cash. But you know what they could do? They're not going to. But they could. Every one of them, when you're licensed, hands you a $100 Saks Fifth Avenue gift card. That's a gift. And it would be okay. Now, we got to learn the difference between what is a gift and then business entertainment or usual business expense. So, you ever heard of whining and dining your clients? Of course you have. So in normal business practice, usual business practice is taking a client out to dinner. All right. So let's use that in the industry. So we've been licensed, securities license since 91. And we're big riders with Legg Mason, let's say. All right. And so Brad Haynes is our vice president in our territory. Brad comes into San Antonio and says, hey, Jeff and Frank. Frank's my upline. Frank's the one on the wall of fame. He's the famous one, my upline. All right. So, hey, Jeff, Frank, I want to take you out to dinner. Once you get a couple of the reps, we'll all go out to dinner. And, hey, let's do it right, man. Let's go somewhere nice. Okay, great. Number one, can Legg Mason take us out to dinner? Yes, absolutely. Do we have to limit the dinner to $100 per person? The answer there is no. And here's why. Because this is not a gift. This would be considered a usual business expense. An occasional dinner would be a usual business expense. Totally legit. They can spend whatever they want. Whatever Legg Mason says is okay. All right. Now, I've been to a couple of professional baseball games. I've seen the Astros play a couple of times. We had dinner at the game, watched the game. I know it cost over $100, but that was considered a usual business expense. Now, what about season tickets to any professional sporting team? No, that's not usual. How about tickets to an occasional play? Yeah, that's fine. Symphony, sure, no problem. Season tickets, not happening. So, usual business expense is different than a gift. Got to track and verify all get to make sure that they're not going over the gift limit. And then we need to talk about a marketing expense. Now, marketing expense is easy. You know how the difference between a gift and a marketing expense? Marketing expense is going to be something that's got the company's name on it. All right, this is a paperweight. Love it. It's got Legg Mason, Golden Circle, top securities producers. All right, so got a paperweight. Oh, look, got my new Franklin Templeton shirt on because Franklin Templeton bought out Legg Mason, and Legg Mason, we're big with Legg Mason. All right, and so then I'm not going to pull out all the hats, and I've got clocks on the wall. I got a rug. I got a carpet. I've got, right, so do your uplines. If they've been around for a while, they've got all kinds of stuff. But these are not gifts. These are considered usual business expense, or in this case, marketing expense, because it's got a company's name on it. Okay, so we're good there. Filing forms. For corporation, well, not corporation, but filing forms, we have our U4s and we have our U5s. The U4 is your initial registration form. Once you pass your SIE, and I mean immediately, you're going to want to fill out your U4 and your fingerprints and submit that immediately to FINRA to get a window open for take your Series 6. It's taking around 2 to 3 weeks right now to get windows open. So that's why you don't want to screw around, because if you study for the 6 and you're ready to test and you didn't open a window, you won't be able to test for 2 to 3 weeks. So as soon as you pass, get your U4 and your fingerprints submitted, and you'll be ready to go when your window's open. So U4, that's your initial registration form. U5 is the withdrawal form. Excuse me. Now, the withdrawal form happens when a rep leaves one broker. Right? They're leaving. They quit, they leave, whatever. U5 is created by the broker dealer. Now, we must file changes within 30 days. And I want you in parentheses to write update U4. So update U4. Update U4. So what do we have to update? Well, change an address, home address or office address. Change in employment. I'm going from one restaurant to another restaurant. I'm leaving the restaurant business, coming full time, right? So employment, things like this. Change in address, change in employment has to be updated. So we've got to file that change within 30 days. There are consequences for failing or filing misleading information. So if you lie or intentionally misrepresent on your U4s, right, that can get you terminated. You can be terminated. I like where they say potential other consequences. One of those potential other consequences is making you retest. Wouldn't that be fun? Now, once you are a rep, you're a registered rep, you're licensed, and you have a felony conviction, or someone files a lien against you, or you file bankruptcy, we also have to update our U4s promptly. If it is an SDable offense, it's got to be updated within 10 days. So you had a felony charge. We have to update that. Okay, we got to disclose it. Turns into a felony conviction, we got 10 days to update it because we can be terminated. Right, we can be SD'd with a felony conviction. Customer complaints. Definition is just a written complaint. The point is it's got to be in writing. So for the exam, we're talking about customer complaints, it has to be in writing. Now, where are they held? They're held at the Office of Supervisory Jurisdiction, the OSJ. They maintain a file of all written complaints for 4 years. That's a 4-year record for broker-dealers. Remember, that's the only 4-year record. Okay, now with that said, any action taken on the complaint has also got to be kept at Office of Supervisory Jurisdiction, OSJ. All right, and now we're going into potential red flags. So what does red flag mean? Red flag means indications of irregularity or misconduct. This is a supervisor thing, right? So like Series 26 exam, okay? Now, we're just touching, remember, mile wide, SIE is a mile wide, inch deep, but this is information that you can see in a lot more detail on the 26. But as a supervisor, we are looking for these red flags, you know, like where there's smoke, there's fire kind of thing. What would have us put the red flag up? Like, oh, okay, I need to kind of keep an eye on that. Unreasonably large trades, right? Like we see a customer that's been doing 2 trades a month. Now they're doing 25. That's a red flag. We're checking for churning right there, right? So there's one. Blanket recommendations. That's what we're seeing from a rep that like every client they've turned in recently has all been given the same recommendation. So it's like a blanket recommendation. Everybody's getting the same recommendation. That could be a potential red flag. See, we're not saying that there is a problem. We're saying it looks like there's a problem and it warrants an investigation or at least a closer look. Identical explanations on many replacement forms. When you're moving somebody's securities from one place to another, and they're going to be charged for that, they're either paying a fee, an additional fee, they're paying additional sales charge, there's costs involved. We have to give an explanation. Why are we doing it? And when we see this at the supervisor level and we see that all these explanations are the same, like, and I'm being a little silly, but client wanted to, 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 I'm like, okay, let's take a look at this. So identical explanations on many replacement forms, red flag. Now these last two, I'm going to let Brian talk about because he didn't have an acquaintance, but he knows the story of a guy that went through this. So Brian, you are up.
There's no complaint that has to be held for 6 years. Complaints are for 4 years.
Okay, complaints. Hold on. They're referencing the MSRB complaints. So under MSRB, Municipal Securities Rulemaking Board only,
incredibly rare.
Complaints, yeah, right, exactly, would be 6 years. But broker-dealer complaints are 4. Yeah, go ahead.
You really want to think of complaints as 4 years. It's incredibly rare that the other gets reported.
Yeah.
Okay. Any new incident has to get reported. The idea with a potential red flag, why do I have 12 different brokerage accounts? Is it because I'm trying to do market manipulation? I want to do it across different accounts so no one can really see it? Or is it because every time I open a brokerage account, I got a free toaster and I collect free toasters? It could be a good reason. It's got to be investigated. There's certain people in our industry that have mandatory vacations. Many years ago, there were people who everyone loved in the office, but they were always there, never took vacations, always helpful. And when they suddenly got very sick, people came in to help them out, do their job because someone needed to do it. And they noticed there was some irregularities and that they had been stealing, embezzling money simply because they were there and they could move the books around. So this new rule of mandatory vacation means if you're doing that, when you're out, people can check and see if the books are out of whack. Now, why don't you want to take a mandatory vacation? Is it because you're trying to do some scheme, some scam, and you need some time to sort of hide it so no one can find it? Or did you find out last week that your kids are off from school next week, and after the last 6 months, just not another week home with the kids? Please, just not another week home with the kids. So, I mean, there could be all kinds of different reasons why it could be legitimate, why you may not want the mandatory vacation. But these are not optional. They basically say you can do whatever you want as long as it involves you not being in this building. Oh, I was checking. Oh.
Yeah, I got ahead of you. Sorry.
Yeah, if I got it.
Another story. Woohoo!
Hold on. Okay, I think we're good. So I have Rule 144, control and restricted. Control stock are those stock that's held by an affiliate, by an insider. The CEO, CFO, some C blank O person, someone who owns a large amount of stock. Restricted stock is those issued in unregistered, generally private offering. We talked yesterday about IPOs and SPOs and FPOs and APOs. The initial, the subsequent, the follow-on public offerings. These are private offerings. Last week, I actually was flown out to San Francisco for one with my good buddy Marky. Marky, you know him better as Mark Zuckerberg. They were having a private offering, and he invited me out there. And when I got off the plane, very nice plane, by the way, it was quite surprising. I mean, Warren Buffett was there, Elon Musk was there, Jeff Bezos, there was lots of people. Don't know why I was there other than I'm the one making up the story. But anyway, what we bought were unregistered shares. This was a private offering. It was unregistered shares. But I'm a nobody. I'm a non-affiliated owner. I'm not an insider. I'm not in the C-suite. I'm just good friends with the founder. So I got invited. Private offerings are not for immediate resale. I have to hold them at least 6 months. I cannot sell them quickly. I've got to wait. But once that 6 months happens, I have no limit. I can sell them whenever I want, however I want. I can sell them all. I can sell some of them. I can do whatever I want. Now, likely we can all agree that Mark Zuckerberg is an insider of Facebook. When he got stock almost 9 years ago now, when Facebook went public in May of 2012, that was a public offering. That was the IPO. Those were registered shares. But as I said, Mark is an insider. He is an affiliated owner, which means he can actually sell them whenever he wants. There's no holding period on those registered shares, but he does have limits on how he can sell them, volume rules. He can sell them up to 4 times a year each quarter. Last week, though, Mark Zuckerberg also bought more shares. This, again, was in that unregistered offering. And he is an affiliate owner, which means they're both restricted and control, which simply means they have the holding period of restricted and the volume limits of control. Questions here? Jeff?
All right. Roles of participants. Investment bankers. We talked about these guys earlier, but a single underwriter of securities. They know what type of financial instrument that should be issued. They understand how to price the company, so they know how to price the shares, price number of shares. Okay, they understand the regulatory requirements, how to navigate the rules and regulations to raise the most amount of money for the issuer. If there's too much risk for one single investment bank, they form an underwriting syndicate. That's what we showed you with the Facebook prospectus yesterday. All those big name companies at the bottom all came together because, Facebook was going to issue 421 million shares. So that was way too much risk for one bank, so they formed an underwriting syndicate. So it's a group of underwriters coming together to help with an IPO, new issue. They spread out the risk. Municipal advisors basically are the underwriters for municipal securities, like municipal bonds. And then types of investors. Okay, a retail investor. This is mom and pop, normal, regular, everyday investor. An accredited investor, we gave you the definition the other day, 1, 2, 3 accredited. They've got to have $1 million net worth or have earned $200,000 a year as a single tax filer or $300,000 a year for a joint tax filer. They've done that for the last 2 years. All right, so 1, 2, 3 accredited. And then we have the institutional investor. These are not going to be natural persons. These are going to be massive companies, insurance companies, banks, investment companies. These are your institutional investors. And now we have types of broker dealers. First, we're going to start off with what is called an introducing or fully disclosed broker. They don't actually handle the trade. They introduce the trade to what is called a clearing or carrying firm. They make the recommendations, but the clearing or carrying firm will settle the trade. If they're allowed to forward money that they receive, it has to be made out in the clearing firm's name and gotten to them ASAP. The clearing or carrying firm, all right? So they act as the middleman to make sure that the trades are settled properly and the transaction is successful. Basically, they're acting with the introducing or fully disclosed. They act as their back office. They make sure everything gets cleared and settled appropriately. And then we have the term prime brokers. Now, prime brokers are not going to work with retail customers. Okay, they're not working with you and me, mom and pop, not happening. They offer special services only to certain clients like hedge funds, market specialists, money managers, but not retail customers. And then we have the term traders. Well, a trader by definition is an individual who engages in buying or selling financial assets in any market for themselves or someone else. Okay, so what's the difference between the definition of a trader and the definition of an investor? That's easy. An investor is long-term. For example, Brian is investing in Primerica stock. He bought it. He's going to hold it, buy low, sell high eventually. So that's an investor. They have a long-term time frame on their investment. Trader, short-term. Trader might place several orders in the morning and close out those transactions at the end of the day. They usually don't hold positions overnight, okay? They are trading. They're buying and selling, short term. They can either work for a company using company money, or they can work for themselves using personal money. That would be called a day trader. And then we have market makers. Market makers are types of broker-dealers. They're very big companies, and their job is to make markets. What does that mean? That means they always offer a bid and ask price. They always offer a quote to buy or sell securities, which keeps the market liquid. What we have to know on the exam, and all we need to know about market makers is we have to look at a market maker quote, understand what it says, and answer a multiple choice question. We've got 2 examples that we're going to use now. All right, first, we're going to learn what a market maker quote looks like. This is a sample market maker quote. They look something like this. Okay, and Brian, if you take a second, if you would connect the numbers for me, thank you very much. This is what it would look like. We're connecting the numbers for a reason. We're drawing that, right? But the quote would look like this. You have to understand how to read this quote. What is it saying? And then apply the answer to an exam question, multiple choice. Okay, so let's do it together. If you remember yesterday, we did a bid and an ask price on a quote. It was actually the same numbers, okay? Now, this is $50-$51. You need to know what is it saying. And I want you to write this down like I did yesterday so you can get this quickly. The little number in this quote is called the bid price. Okay, the bid price. And you want to write that underneath the 50, write we sell. So we are retail investors. So write down retail investor, we sell. So when we see 50-51, we know as retail customers, we would sell the security at $50. So retail customers sell at the bid, which is the little number. We also know that retail customers will buy. So write down we buy at this number, which is the asked or offer price or public offer price. All right. So now that you know that we sell at the bid price and we buy at the asked or pop, big number, we have to know the opposite side of that trade. So if we are selling, somebody else has got to be doing what? Buying, right? If we're selling, we got to sell to somebody. So the quote in parentheses is what the market maker, we're going to call them they, okay? The market maker is willing to do. In this case, where it says 10, this stands for lots of stock. So 10 is actually 1,000 shares because 10 times 100 shares in a lot is 1,000. So what this is saying, what this connection, 50 to the 10 in parentheses, this is what it's saying in English. They, the market maker, will buy, so you put they buy underneath the 10. They'll be willing to buy up to 1,000 shares at $50. We sell, they buy. They buy, we sell. All right. And so in this quote, this connection of the 50 and the 10, could we buy 500 shares from the market maker? Yes. 600? Yep. 200? Yep. How about 1,500? No, because they're saying that they would only buy 1,000 shares. 1,000 or less would work. That's what this is saying. For $50, we could buy up to 1,000 shares. I mean, we could sell up to 1,000 shares from the market maker. So we sell, they buy, and that's market maker. Okay, that's the first connection. Second connection, we buy, retail customer buys, we'll buy at 51, and the market maker saying they are willing to sell, so they sell, and this stands for 2,000 shares, up to 20 lots. That's 2,000 shares. Okay, so with this quote, could we buy 1,500 shares? Yes. 1,000 shares? Yep. 800 shares? Yep. How about 2,500 shares? Nope. They have 20 lots, 2,000 shares. They would be willing to sell, so we can buy. All right, so those are your connections. Let's run this through here. All right, a market maker publishes a quote, 40-4050, 8 times 12. Given this quote, a retail customer would be able to do what? What would a retail customer be able to do? All right, we've got our quote. And if you would immediately write down what we wrote in the last one, we sell, we buy, they sell. All right, you got all that down. Now let's figure it out, because the order doesn't change. So let's start with A. Can a retail customer buy 1,000 shares at $40? So the first thing I look at is, do we buy at $40? What does it say? It says we sell at 40. we buy at 40.50, right? So we can't buy anything at 40. So A is out. We've eliminated that already. We sell at 40. Okay. So could we sell at 40? Yeah, that's a possible answer. B is a possible answer. Can we buy at 40.50? Yes, we buy at 40.50. So that is also a possible answer. Can we sell at 40.50? No. We wrote it in. We buy. So we can't sell at 40.50. So A is out and D is out by process of elimination, just knowing the connections, right? We sell, we buy, they sell. We're good. All right. Now that gets us down to two answers. We call this a coin flip. Brian's going to take over and explain the coin flip idea and how to finish answering this question. So Brian, you're up.
The idea with the coin flip is that there's 85 questions on this test. Let's say half of them you know, and half of them, you don't. But you can get them down to 50-50. What I see when I look at this, well, this half the test, you know. And this half the test, well, you don't know. We've been through that. But you're flipping coins, so you're going to get half of them. I see a 75%, which is a pass across all exams. Coin flips are our friend. The idea, I would focus on each of these has 1,000 shares. Okay, buy or sell. Gosh, I can't ever keep these straight. But we have these as the numbers. And if they're doing 800 and we want to buy or sell 1,000 and they're only buying or selling 800, that's a problem. But if we want to buy 1,000 and they're buying or selling 1,200, I mean, that's fine. So clearly it's got to go with the 12. The 12 goes with the 40-50, which means it can't be with the 40. Now, Jeff said it's not A or D. I said it's not A or B. What could the answer be? What could it be? Sometimes the easiest way to answer the questions is to find which three are wrong. You don't necessarily want to always look for what the right answer is. If you know three are wrong, not a lot of choices left. But the only reason we know that C is the correct answer here is because we know that A, B, and D are not. There's nothing in this question that implies a fill in the blank that C is going to be the answer. Jeff?
All right. Thank you. And I'll give you a second to screenshot this if you like. And we got one more of these to do. All right. So here's the question. Brian's going to connect the numbers for us, but a market maker publishes a quote of 75, 76, 12 times 22. What is this quote saying? All right, so this time, let's start at the bottom. Brian's writing in important information, so keep that in mind. Let's start at the bottom. The market maker will buy up to 2,200 shares at $75. So we've got 2,200 at $75. All right, let's take a look. 22 and 75. Oh, wait a minute. 22 is never connected to 75. So you know what? Even if I don't know what I'm talking about, this can't be right. D is out because 22 is never connected to 75. Let's check the other answers. Look at this. B is out also because 22 cannot be connected to 75. So we've already eliminated B and D because 22 and 75 are not connected. Well, let's go to C. Market maker will buy up to 2,200 shares at 76. They say market maker buys. Do you remember the words that we wrote in? We sell, we buy, they sell. On the 22 and 76 that are connected, is the market maker buying or is the market maker selling? Let's go to C. Market maker will buy 2,200 at 76. Are they willing to buy 2,200 at 76? No. Who buys at 76? We buy. They sell. So C is out. One more time, let's check the answer. This is the only one left. 2,200 at 76. Market maker will sell, and that's right. The market maker is willing to sell up to 2,200 shares for $76. Or we will buy at 76 up to 2,200 shares. So A is our answer by process of elimination. So if you can just get in the habit of, in this order doesn't change, right? So you just put we sell, we buy, they sell, then you connect, and then you can figure out any answer. It doesn't take long. All right, I'll give you a second on this. And let's keep moving. Depository and clearing corporations. The big one is Depository Trust and Clearing Corp. This is DTCC. They're the ones that provide clearing and settlement services. You remember T+2? Corporate securities and municipal securities settle T+2, trade date +2. These are the guys that make sure that happens. Clearing is all activity from the time of commitment until it's settled. So what is the time of commitment? That's the trade date. Remember trade date? Trade date's the date that both parties agree to terms. And then settlement's when we act on the terms, meaning you wanted the stock, so we get you the stock, you get us the money, we're settled. I get mine, you get yours, that's settlement. Clearing is the whole process from the trade date until it settles. A to Z, done. Settlement is part of the clearing process at the end where we exchange the securities for the cash. That's settlement. It's part of the clearing process. Options Clearing Corporation provides clearing and settlement for options. And then we can talk about positions in mutual funds. All right, so positions in mutual funds. Well, mutual funds have board of directors. They're elected by the shareholders. They approve and hire the investment advisor, transfer agent, custodian. And the board of directors of a mutual fund is the only ones that can authorize dividends. All right, so investment advisor. The investment advisor is the one that makes the decisions to buy, sell, or hold. They're the ones that are making the investment decisions. Transfer agent. Transfer agent is also known as shareholder services. Shareholder services. Because they work for you, the shareholders, like customer service. They record the transactions, they issue and redeem your shares, and they distribute your dividends. Shareholder services, like customer service. And then we have a custodian. Custodian's a bank. The bank safeguards the securities. They record the inflows and outflows of securities and cash for the fund. So a custodian of a mutual fund is a bank. And then we have underwriter. Underwriter is also known as the distributor or sponsor of the fund. Today, most mutual funds self-distribute, self-underwrite. What does that mean? Well, that means that Legg Mason is the underwriter for Legg Mason funds. Pioneer's the underwriter for Pioneer funds. American Funds is the underwriter for American funds, and so on. And then we have certain disclosures that have to be made when we're selling mutual funds. So what are the required disclosures? We have to disclose financial condition. If we have a shareholder that wants to see our financial records, we have to get them a balance sheet. Remember, it's their money. We have to disclose investment policies or objectives. I showed you this yesterday. But right here, I know it's hard to see on the screen, but investment objective, right here of a mutual fund, investment objective, we disclose it on the prospectus. We have to disclose it, right? We have to make that disclosure. It's on the prospectus or in the prospectus. Now, if we want to change, if a company wants to change their investment policies, it can only be changed with a majority vote by the shareholders. We have to disclose all fees. We have to disclose the investment company fees. Those are the mutual fund fees and the investment advisory fees. The company managing the money. They charge too. Of course they do. We have to disclose fiduciary responsibility. The term fiduciary is the duty, obligation of loyalty and good faith to someone or some entity. It's the highest duty known to the law. Full disclosures of conflict of interest. If there's any conflict of interest, we have to disclose that as well. And then mutual funds have voting rights. They have voting rights. So how do you vote by mutual funds? Do you show up to a board or to a shareholder meeting? Nope. Most people vote in absence. It's called proxy. You're basically giving your voting power to a representative of the company. And then they agree to cast your votes for you, but how you wanted them cast. Excuse me. So basically, absentee ballot. You're giving your voting power to someone else. That means proxy. They're voting for you. And then we have the privacy requirements. Regulation SP. That stands for secrecy and privacy. And it's the policy of the company. How are they going to handle your non-public personal information? How do they keep it safe? So definition of non-public personal information, personally identifiable information that is not out in the public. Because if it's already publicly, out there, then we're not responsible for keeping it non-public if it's already been made public. The the privacy policy flyer, that's what this is for us, right? This gives the information to the customer on how we're planning on keeping their information confidential, who is going to have access to this, who are we going to share it with. That's all included on the policy notification, the privacy policy flyer. This must be given to the customer at the time of the sale. No exceptions, Zoom included. We've got to get them a copy at the time of the sale. And then the broker is required, or the company is required to get one out to every client annually. Now, clients can opt out of the annual update, but it's got to be made easy. What do we mean by made easy? Well, if I don't want to receive the annual updates anymore, I want these to stop coming in. One way would be go to the website, check a box. If that's an option, that's an easy option. Do that and it's done. They can send out a postage paid envelope, check a box, put it in the mail. That would be considered easy. Having you have to write an essay on why you don't want to receive one, yeah, that's not going to happen. That's not easy. Then we have trustees, custodians, executor, and executrix. Let's talk about those. So the fiduciary is the one with the responsibility to act in the best interest as stated in the documents. If they're the fiduciary, they must act in the best interest of the stated purpose of the trust, not necessarily in the beneficiary of the trust or the owner of the trust. Depends on how the trust document is written. Custodians are more generally picked. Trustees are more, well, let's do it this way. A custodian of an UGMA or UTMA account. You've heard of UGMA and UTMA accounts. We talked about them yesterday. They're for minors. The custodian is the acting fiduciary in that account. They have got to act in the best way for for that child. No exception. That's custodian. Now, custodians are more chosen. Like I might pick my wife to be the custodian or grandma to be the custodian. Trustees are more legally assigned. If we were opening up a family trust, of creating a family trust, we're not going to assign grandma, as the trustee, right? We're going to hire a lawyer, somebody that does this for a living, and they will be the trustee, more legally assigned. And then the last thing, the terms executor and executrix of an estate. The only difference between those two is the gender. So, for example, in my mother-in-law's case, when my father-in-law passed away 3 years ago, almost 4 years ago now, my mother-in-law changed her will. She named her son executor and my wife, her daughter, executrix. The only difference is the gender. All right, Brian, we got to where we needed to get to.
Okay.
This is our lunch break.
Oh.
It was
Well,
abrupt.
I heard the fade. I need to switch that. I know how to fix that now. Sorry about that, folks. It's a new audio mixing board that I'm playing with because, long story.
Uh-huh. All right. Well, with that said,
Looking good, Billy Ray.
Feeling good, Lewis.
Let's keep moving. All right, so Chapter 4, Economics. Here we go. So we're going to start with monetary and fiscal policy. Monetary policy. Monetary policy is controlled by the Federal Reserve Board. That's FRB. So they handle United States monetary policy. So basically, they set a policy of either loosening, like loosen your shoestrings, or tighten your shoestrings. They've got 3 tools that they can use to help them implement that policy. Now, we're going to cover those 3 tools. The first tool is FOMC. FOMC. This stands for Federal Open Market Committee. Federal Open Market Committee. And this is where the Federal Reserve Board directs FOMC to either buy or sell U.S. government treasuries. Okay? And they'll direct them to either buy or sell depending on the policy that they're implementing of loosening or tightening. The second tool is the discount rate. The discount rate is an interest rate. It is the only interest rate that's set by the Federal Reserve. And they will either choose to raise the discount rate or lower the discount rate depending on what policy they are trying to implement. And the third tool is the reserve requirement. The reserve requirement is that banks must keep X amount of dollars in reserve at the Federal Reserve. And the Federal Reserve will raise or lower the reserve requirement depending on, depending on what policy they're trying to implement. So the 3 tools that they have in their little tool chest at Federal Reserve Board is FOMC, the discount rate, and the reserve requirement. Regulation T is also governed by the Federal Reserve Board. This sets margin requirements. We talked about that yesterday. We know currently it's 50%. So if you wanted to buy $10,000 worth of securities, you'd have to deposit $5,000, 50%. We learned that the minimum was $2,000. So even if you wanted to buy $3,000 in securities, you'd have to deposit $2,000, not $1,500, because that's the minimum. If you borrow the money, you got to pay the broker back within 4 business days, or your account will be frozen for 90 days. And the only way you can trade is Cash only. No more borrowing. All right. Primary focus of the Federal Reserve is to control inflation. They supervise and regulate banks. Goal is to maintain a stable financial system. They set the policy, the monetary policy for the United States. One of two: tighten or loosen money policy. So let's find out what all that means. All right, here's a picture of the United States, obviously. All right, now, what it's showing here are 12 Federal Reserve districts. Okay, you got 1 all the way to 12. So 12 Federal Reserve districts. In each one of the districts, there's a little black box. These little black boxes are called member banks. They're known as member banks, Federal Reserve banks. For example, Federal Reserve Bank of Dallas, Texas, Federal Reserve Bank San Francisco, Federal Reserve Bank Kansas City, St. Louis, Cleveland, Atlanta. Got the idea, okay? So in every region or every district, there's one member bank. I refer to them as little black boxes. They're also known as money centers. Money centers. So here is the answer to what the Federal Reserve can do and why they do it. Okay, they have two policies. One of two they can implement: loosening, which is increase money in the economy, or tightening, which is decrease money in the economy. They have 3 tools they can use to either increase or decrease money in the economy. All right. Now, I want you to picture this, picture a fireplace, logs in a fireplace. The logs are going to represent the economy, okay? And we need the economy to be on fire, right? We need it to be burning, doing well, okay? Now, if you just take a match and hold it to a log, you're going to have a hard time getting that log to catch, getting the economy to catch. That's why we talk about loosening and tightening, increasing money in the economy or decreasing money in the economy, because money is like kindling to the fire, right? We're going to shove a bunch of sticks, a bunch of paper underneath. We're going to light that. It'll slowly catch and then slowly catch the economy, the logs. All right. And so the kindling that we're talking about are these 3 tools to get the economy lit up. So if we're in a situation like we are today, where you have very high employment, economy's, on the teeter-totter, you don't know what it's going to do. Is it going to go up? Is it going to go down? It has crashed and burned this time last year. So the policy of the Fed was to increase money in the economy. They had to get a bunch of kindling underneath the fire, underneath the logs, to get it to catch fire. So they directed FOMC to buy all the treasuries they possibly could, right? They say, buy treasuries, unlimited, blank check, buy as many government treasuries as you can. Because when you are buying, you are putting money into the economy. Second, they directed themselves, right, to lower the discount rate. So the Fed lowered the discount rate. Now, when the Fed lowers the discount rate, banks follow. They lower their rates, which encourages borrowing. Because when do we want to borrow money? When do we want to buy our cars, our houses, our stuff? When interest rates are low. So by lowering the discount rate, banks will follow lowering their rates, and that encourages borrowing. Borrowing, right? Borrow the money, you spend the money, more kindling under the fire to get it to catch fire. So they've got FOMC buying treasuries. They lowered the discount rate. In real world, the discount rate is at 0.25%. You can't go much lower than that, or we'd be at 0. So discount rate's at 0.25%. So they lowered it to increase money in the economy. Third, they decreased the reserve requirement. The reserve requirement is like the least used of the tools. It's rarely used, but it's being used right now. They decreased the reserve requirement, the amount of money that banks have to keep on hand, because the less money banks have to keep on hand, the more money they can loan out to customers. So when the Fed implements a policy of loosening, they're going to be buying treasuries, lowering the discount rate to encourage borrowing, decreasing the reserve requirement so banks have more to lend out. That's loosening. Now, at some point, what's going to happen? You got all that kindling underneath, right? We're putting all that stuff underneath. It's going to catch fire. Now we got a blazing fire going in the fireplace. Things are great, man. We're rocking. But we start rocking a little too good, they've got to tighten. So they've got to get money out of the economy. When they just when they make the decision, the Fed makes the decision that we need to tighten the economy, get money out, okay, then they direct FOMC to sell treasuries. The Federal Reserve will raise discount rate, which will slow borrowing. They'll increase the reserve requirement so banks have less to lend out. And that's money policy, Federal Reserve in a nutshell. So now when you hear it in the news, they lowered the discount rate, you know what that means. Oh, man, they're trying to get money into the economy. So when the economy is stinking up the place, right, high unemployment, economy's blowing up, businesses are shutting down, they got to get money in, loosening. Things start taking off, they start tightening, start pulling money out. Fiscal policy. Fiscal policy is controlled by the president and Congress. Primary focus is to stabilize economic growth and high levels of employment. So, kind of skip through that kind of quick. So this is government spending money. So what's examples of fiscal policy? Taxes, raising taxes, lowering taxes. That's a fiscal policy decision. Back in 2008 and 9, what did the government do? They bailed out the banks. They actually gave billions of dollars to the banks. Too big to fail. They gave money, well, they loaned money to the car companies, right? Too big to fail. So they made a fiscal policy decision to do those things. And anything the government spends money on or cuts spending money on is fiscal policy. It's like the budget. President and Congress. All right, let's talk about the interest rates that we'll see on the exam. First one's the discount rate. We've touched on that. We know right now the discount rate is the only rate that the Federal Reserve actually sets, but what is it? All right, so humor me here. This is the rate that member banks, little black boxes, remember the United States picture, the little black boxes? Okay, little black boxes, member banks, borrow from the Fed at. If the Federal Reserve Bank in Dallas, Texas needs to borrow money from the Federal Reserve, the interest rate they receive to pay back, the discount rate. It's the only rate that's directly set by the Federal Reserve. So when a member bank, little black box, borrows from the Federal Reserve directly, that's the discount rate that they're given. Federal funds rate. This is the rate that member banks borrow from each other. Federal Reserve Bank in Dallas, borrowed from the Federal Reserve Bank in Atlanta. Or the rate commercial banks borrow from member banks from. The target is set by the Federal Reserve, but the rates are set by the individual banks. And you think, well, why would a bank need to borrow from the Federal Reserve? All right, because they have reserve requirement. Banks have reserve requirement. And if they figure it out that they're going to fall below, they're not going to meet the reserve requirement by the end of the day, they take a short-term loan, like an overnight loan, to cover that deficiency that would happen, because you can't not have the reserve. So if they're going to fall below the known reserve, they would borrow overnight at the federal funds rate to make sure they stayed in compliance. By the way, commercial banks, Wells Fargo, Bank of America, Chase, those are commercial banks. Member banks are the Federal Reserve banks, the little black boxes. There's 12. Broker call loan rate. The broker call loan rate is the rate used for margin accounts. Okay, the way that works is, let's say I'm the broker, you're the client, you open up a margin account, deposit $5,000, say, Jeff, I want to buy $10,000 worth of stock. I say, okay, great. You hit the 50% equity part. I call my bank. Brian is my bank. Brian loans me money for the margin loan. The rate that Brian gives me, so the rate the broker's bank gives the broker, that's the broker call loan rate. It's for margin accounts. It's also been shown on the test as the call loan rate or the call rate. So any combination of these words, this is the rate that they're talking about. And then the prime rate. The prime rate is the rate that commercial banks give their best credit-worthy customers. Bank of America, Chase, Wells Fargo all have a prime rate, and those prime rates are different. Okay, I'm sure by razor edge because they got to be competitive, but it's the rate that their bank gives the best, their best rate to the best clients. We get the prime rate too, but we're going to get the prime rate plus points to borrow money from these banks. All right, business economic factors. So now we're going to go into a little bit about accounting, okay? Yep, remember, SIE, mile wide, inch deep. We don't have to be accountants to do any of this, but we have to know some basics. So let's talk about balance sheet. What shows up on a balance sheet? A balance sheet lists assets and liabilities. That's for a corporation or an individual. So assets and liabilities show up on a balance sheet. An individual's net worth is their assets minus their liabilities. If we're talking about a corporation, though, it's known as shareholder equity. That's the net worth of a company. So, for example, Brian has a net worth. You have a net worth. I have a net worth. Starbucks has shareholder equity. It both means their assets minus liabilities, but for a corporation, it's known as shareholder equity. Stocks and bonds that we own are assets. Credit card balances are liabilities. This is a balance sheet. Income statement. Income statement measures income and outflows of money. The stock that we own is an asset. The dividend that we receive is cash in. All right, let's use Brian. Brian owns Primerica stock. So Primerica stock will show up on Brian's balance sheet as an asset. Now, Primerica pays a quarterly dividend. Doesn't pay a big dividend. Remember, we're still in the growth phase, man. We're trying to grow. We're a mid-cap company. So we don't pay big dividends, but we do pay dividends. The dividend that Brian receives will be cash into him, and that would show up on Brian's income statement as just that, cash in. If we were talking about a corporation, which is what you're going to see on the test, let's use this example, and we'll use Exxon. A bond that Exxon issues is a liability to Exxon because what's a bond? You are loaning money to the issuer. You're loaning money to Exxon. Now, they've got to pay you back, and they pay semi-annual interest. So the actual bond would show up on Exxon's balance sheet as a liability. The semi-annual interest that we're paying the bondholders back would show as cash out for Exxon on their income statement. And that's basically what we need to know. At this point, something has hit the fan, but our code of corporate conduct prevents me from talking about it. All right, let's talk about business cycle. Couple of different ways that you can be tested on business cycle. Brian eventually is going to start scribbling some letters over here. He hasn't lost his mind. It's actually going to be part of the exam. But here's what we're going to cover while he's doing that. All right, I want you to look at the business cycle. First thing you want to know is there's four cycles. There are some books that show 6 cycles. There are 4. If you get tested on how many cycles, there are 4. You've got to know the cycles and their alternative names. Okay, let's start with expansion. The term expansion, when we're in an expansion, that is also known as recovery. So write it down. Expansion is known as recovery. Please write it down. Because on the exam, they could give you either one of these. Then we head to peak. Peak is also known as prosperity. Peak is known as prosperity. Write it down. From there, we head into a contraction. Contraction is also known as decline. Decline. Now, gets a little trickier on a decline because depending on how long we are in a decline, we might reach the level of a recession or a depression. Pay attention to this. You need to know the definition of recession in quarters and months. All right. If we are in a contraction for 2 consecutive down quarters, that's a recession. That's the definition of recession. 2 consecutive down quarters. There's 12 months in a year divided by 4 quarters. 3 months in a quarter. So a recession is 2 down quarters or 6 consecutive down months. 2 down quarters, 6 consecutive down months, recession. If we are in a decline / contraction for 6 consecutive down quarters, which is 18 consecutive down months, now we're in a depression. Just because we're in a decline, just because we're in a contraction, doesn't mean we have ever reached the level of recession or depression. So you got to pay attention, know the answers by months and quarters. They've both been tested. And now I'm going to turn this over to Brian so we can close out this part, understand how this works.
The idea, you want to make sure, don't just focus on specific words. The idea is it goes up, it hits the top, it goes down, it hits the bottom. It goes up, it hits the top, it goes down, it hits the bottom. Look at the words and options that are going to be there. Remember, the answer is always in front of you. It is not a fill-in-the-blank test where you've got to make sure you know exactly what word you've got to fill into the blank. The words are in the answer. The important thing here is to make sure you understand the order. It goes down, it hits the bottom, it goes up, it hits the top. It doesn't go down and then hit the top. That doesn't make any sense. It doesn't go down and then up. It has to hit the bottom first. So we want to look at it. Is this the correct order? Does it go peak? Nope, that jumped. That's not right. Nope, not that one. What about this one? Does it go expansion, contract? Nope, not that one. What about this one? Does it go contraction, trough, expansion, peak? Oh, yeah, that one looks pretty good. Let's just check for completion. Maybe I messed up. Does it go trough, peak? Oh, nope, we skipped one. So our answer is going to be contraction, trough, then expansion, peak. It doesn't start at expansion. It doesn't start anywhere. It's just, as I explained, from my understanding of how this works, it started 50,000 years ago when the first caveman left his cave and traded a green rock for a purple rock from a different caveman. That's when the business cycle started, when the first trade happened, when humans started trading. I have no idea when that began. It doesn't matter. You know what follows.
All right. Here, Brian tells that story about the caveman with these little tails. See, it doesn't stop. It's not like a period. Okay? It's leaving, right? Like you said, and it just continues. All right. Now, people always ask when we get here, how do we know where we are now? Or where are we now? All right. The exam answer is going to, well, I'll tell you the exam answer once we go through the cycles, but there's an exam answer to that question. Where are we now? Okay. All right. So let's go through what happens in each of the cycles. In expansion, also known as recovery, the GDP, gross domestic product, is increasing. Okay, we're going to go through GDP. Brian's going to cover that on a separate slide. GDP is increasing. Unemployment is around target, so we're comfortable. Unemployment's where it should be. Inflation is near target, so we're comfortable with pricing. Everything's where it should be. The stock market is obviously bullish. That's why we're moving up. Because the stock market's bullish, you know, and the economy's moving up, we have money. Right? We're working. We've got our hours. Things are looking good. So when we have money, we are buying stuff. So in an expansion / recovery, we're going to have lower inventories of stuff, because we have high consumer demand. When we have money, we're buying down the inventories. This happens in an expansion / recovery. From there, we had to peak. Peak's awesome, man. We're cranking. Things are good. We're rocking. Okay, but now the economy and the peak is starting to overheat. GDP is growing above target. Inflation is now greater than target. Remember, and inflation is a rise in prices. So we got to get that under control. We can't keep having prices go and go and go and go and go. So from a peak prosperity, we head into a contraction. This is where growth is weakening. GDP is falling. We now have higher inventories of goods because we have lower consumer demand. Remember, we're in that contraction. We're in the decline. Hey, we're not spending money on anything that we don't have to have. Okay, necessities, baby. So we're going to have rises in inventories because we have lower consumer demand at this point. And then we hit the bottom. There is no alternative term for the trough other than just bottom. Trough means bottom. It's the opposite of peak. The economy's at the bottom. GDP is below target. Inflation is less than the target. This is the trough. It's rock bottom. And now people ask the question, where are we now? Okay, the answer to the exam question to that question is generally we know in hindsight. We're going to know the business cycle in hindsight. We look back and say, oh, there was the peak because the next day we went, whew. There's the trough because the next day we started to go up. So we know the business cycle in hindsight. You see that on the exam? That's your best right answer. And then we talk about elastic and inelastic. I'm going to have Brian talk about this, and then I'll give you my 2 cents as well. Then we'll move on. This is starting to be tested. So there you go. Brian?
The idea with elastic means it's going to move with, why is this not working? It's going to move with the economy. It's going to be responsive. When the economy rises or falls, these are going to rise or fall. Inelastic, also known as defensive, are things that are not going to be as effective. Things that are generally thought of as necessities or things that are very hard to give up. Liquor, cigarettes, think about things that probably didn't lose a lot of money last year at any point.
All right. And so my 2 cents, okay, an elastic good in its simplest form, the idea is elastic means that when the price of these goods go up, the demand will fall because there's more alternatives. Brian talked about expensive food. That's right. I love filet mignon. It's awesome. Very good. But it's already expensive. If the price of filet mignon went up, right, the demand is going to go down. It's elastic because I can go buy hamburgers. I can go buy fajitas. I have alternative. That's elastic. Inelastic, just write the word necessity. Got to have it. The best example I have personally is under pharmaceuticals. I had a kidney transplant 11 years ago. Actually, it'll be 12 years in August. Hallelujah for me, right? Miracle. So here's the thing. I've got anti-rejection medicines I have to take. They're not cheap. Even with insurance, they're not cheap. I mean, they're expensive. And let me tell you, if the price doubled again, guess what I'm going to continue to purchase? Demand will keep up with the increase in price. That's inelastic. It's a necessity. We've got to have it. Electricity. Do we stop using electricity when the rates go up? No. Brian's point about cigarettes or alcohol, right? No, they continue. Those are defensive goods, right? Okay, so this would be inelastic. All right, so there's my 2 cents. Hopefully that helps you out in an exam question. And then we go into principal economic theories. There's 3. They're theories, but they're all pretty much tied together, okay? They think different things, but we use them together. This world that we're living in right now is a perfect example. So let's run through these. But for the SIE, what you need to know, we're going to try to give you some word association. You hear this theory, think of these terms. That's what we're looking for to get the right answer on the exam. First one is the Keynesian theory. John Maynard Keynes, 1930s England, came up with the theory of demand side. Demand side means borrow and spend, right? Borrow, spend in the short term to get the economy out of the recession, out of the downturn. Who's the number one? What's the number one entity that can spend money? How about the government? So they're all about like government spending, borrow, spend. Okay, have you ever heard the term stimulus? Anybody? Anybody? Trillions of dollars in stimulus over the last year. What was that stimulus? Getting money to us, getting money to business, getting money to other, states and government, right? To do what? Spend that money. Get it into the economy. Kindling for the fire, get the economy to catch. We'll get it paid off later. The debt. All right. So government spending, stimulus. This is demand side economics. Borrow and spend. And right now, we're at full tilt. I mean, we just did another 1.9 trillion. I forgot, but there you go. And there might be another round. Who knows? But the point is, this would be a Keynesian theory. This is part of the Keynesian theory to turn around the economy. Now, monetarists. Monetarists, let's go back to the picture that Brian had for us on money policy. Remember the three tools that the Federal Reserve has? This is what the monetarists believe. Change in money supply, controlled by FRB, are the most significant determinants of economic growth in a business cycle. Right. So when monetarists hear that the Federal Reserve is either raising or lowering interest rates, they are raising or lowering the discount rate, buying or selling government treasuries, raising or lowering the reserve requirement. These are all decisions that the monetarists believe will affect the economy in the best way. Anything having to do with those decisions, those are monetarists. And then we have the supply side guys. Now they believe they kind of want the government short term to step aside. And what I mean by that is they want them to say, look, you want to turn the economy around? I'm a supply side guy. Lower my taxes, deregulate my industry, let me do what I do best. All right, we got examples of that too. They suspended for a short period of time, they suspended the payroll tax to help businesses. So they lowered taxes. Not forever. They're coming back, but temporarily to get things turned around. Deregulation of industry. How about masks? Man, when this thing blew up, there were no masks. So what did the government do? They deregulated the industry. They let us use things like this. Right? Woohoo. So
still doesn't make you sound like Darth Vader. You need a lot more reverb and background.
Very nice. All right. So that's a ventilator mask by 3M. This is used to keep people from getting chemical poisons, like when they're painting cars in a booth or working around hazardous chemicals. All right. Well, I got sent that mask from my kidney doctors. Right. I had a kidney transplant. As soon as this thing blew up, I got that in the mail. That's not a medical grade mask, but it was deregulated. All the doctors, nurses, first responders, they ran out of masks. So you know what they're allowed to use? Contractor masks. They could use N95 masks, right? Deregulation temporarily till they got caught up with surgical masks and everything else. Okay, that would be a supply side guy. Lower taxes, deregulation. They're talking about the supply side guy. So that's how you tie all this together. And right now they're all moving. I just gave you examples. We have stimulus. We have the monetarists working, the Federal Reserve, lowest discount rate lately, 0.25%, buy all the government treasuries, decrease the reserve requirement, supply side guy, they've lowered taxes temporarily, deregulated some industries to help. Everything's working together. And that leads us to gross domestic product and gross national product. Brian, you're up.
So gross domestic product is all production within a country?
Hey, Brian, you're not muted, but you're very, very low volume.
How about now?
That's perfect.
Super weird. GDP is all production within a country. GNP is all production by the citizens of a country. What do we mean? Well, if we have a German citizen that works in the United States and an American citizen lives and works in Germany, the German citizen is living and working in the United States. They are producing in the United States. That is U.S. GDP. But they are a German citizen. So Germany gets GNP. That American citizen that is living and working in Germany isn't contributing in Germany, so Germany gets the GDP, but they're an American citizen, so it does get credited as US GNP.
All right, let's talk about some more economic money stuff. This is going to be some definitions. Inflation. All right, the simple definition for inflation. Bottle of Febreze, $4.50 at Walmart. There's only one. And we've got almost 200 people in class, and you all want this one bottle of Febreze. Can I charge more money for it? Absolutely. Inflation is a rise in prices because we have too much money chasing too few goods. That's inflation. Inflation is when we have rise in prices. Now, deflation. Deflation. Deflation is the general decline in prices. This is caused by a reduction in the supply of money or credit. We don't have any money, and the banks won't loan us any, so there's no credit. So deflation, again, is going to be caused by a decrease in government spending, your personal spending, and investment spending. All right? There's no money in the economy. That's the point. We don't have money, and we can't get credit. Deflation. And then we have stagnation. Whenever you hear about a stagnant economy, it's a combination of two factors to give us a stagnant economy. Here they are. Stagnation occurs when we have slow growth and high unemployment. When slow economic growth and high unemployment come together, this is where we have stagnation or a stagnant economy. If we add one more factor, we have stagflation, because what stagflation is, the combination of stagnation and a rise in inflation. So stagflation, slow growth, high unemployment, rise in inflation. Stagflation. This leads us to economic money factors. What we're going to do in this part is we're actually going to go through one of Brian's animations. This animation is going to go through strong and weak dollar, import-export business. That's what we're going to hit now. And again, it's going to be an animation that he's setting up. So Brian, are you good? Do I need to stall or are we good?
We're about good. Push. How's my volume?
Your volume's way low. Really low.
I don't know.
That's a little better.
Only a little better?
Only a little better.
What is happening? Because the problem is, again, I don't want all my background noise to overpower.
I think Darth Vader invaded your box.
No, because I wanted to try and lower Darth Vader's voice, and I think.
Well, you sound good now, and I'm not hearing any background from you. Okay,
I can go like this. How's this?
Okay, that's loud, but it sounds weird.
How about now?
That's pretty good. Let's go with that one.
This is the way it was, and about to fix Vader later. Okay, so let's see. We should be able to hear. Let's go share the screen. You're going to be able to hear it. It's going to start off white, but as long as you can hear it, you're good. Currency is a weird and complicated topic, especially valuing currencies. One of the things that we have to make sure we understand is that although most investments can move in a vacuum, currencies cannot. All stocks could be flat, as in not moving, not up or down, and IBM or any other given investment, given stock could be up or could be down all by itself, all by its lonesome. Currencies cannot move by themselves. For a currency to increase in value, that means that other currencies have gone down in value. For the dollar to go up, that means the euro or whatever else the question is comparing against must have gone down. Let's look at an example. Let's pretend there's a European car that is sold for 10,000 euros. There's also an American car that is sold for $10,000. If the exchange rate is equal, that means $1 buys €1 and €1 buys $1, then the $10,000 American car is also a 10,000 euro car in Europe. And that 10,000 euro European car is a $10,000 car in America. So whatever the demand in Europe for the American car and the European car is, and whatever the demand in America for the European and American car is, they're now equal prices. In America, American cars are exported to Europe, and European cars are imported to America. In Europe, American cars are imported from America, and European cars are exported to America. What if the currencies change? What if the value changes? What if now the dollar strengthens? That means now it takes €2 to buy $1. So $10,000 is actually now the same as 20,000 euros. And 10,000 euros is now the same as $5,000. So in the United States, the American car is still the same, $10,000. But that 10,000 euro car, European car, now only costs $5,000 in America. In Europe, though, the European car is that same 10,000 euros. But that $10,000 American car is now a 20,000 euro American car. You could imagine in that situation, the demand for each would likely change. Likely more people would be buying that $5,000 European car that is imported into America. So you could imagine importing would be profitable. But in Europe, people will likely be buying less of that 20,000 euro American car compared to the 10,000 euro European car. So American exports will go down. When the dollar goes up, exports go down, but imports go up. What if currency changes the other way? What if now the dollar weakens from originally? That means it takes $2 now to buy €1. So $10,000 is actually now 5,000 euros, and 10,000 euros is now the same as $20,000. This example is the same as what we just did, except reverse. Now in the United States, that American car is still the same $10,000, but that 10,000 euro European car now costs $20,000. In Europe, though, that European car is the same 10,000 euros, but that $10,000 American car is now only 5,000 euros. You could imagine, again, in that situation, the demand for each would change just like before, except now in opposite ways. Likely, more people in America would be buying the $10,000 American car as opposed to the now $20,000 European car that is being imported. So imports will likely be less profitable. But in Europe, people will likely be buying more of the 5,000 euro American car than the 10,000 euro European car. So American exports will likely go up. When the dollar goes down, exports go up and imports go down. Uh-oh. Click. There we go. So the idea here, eventually this will work. Modern technology. There we go. This is the chart. Remember, you're taking the SIE exam, not the SEI exam. Maybe that'll help you remember how this chart is built. And then it's just up, down, and down, up, down. Remember, if they tell you the euro is going up, that means the dollar is going down.
All right, U.S. balance of payments. U.S. balance of payments. What is U.S. balance of payments? It's just the record of all economic transactions between residents of the United States and the world over a particular period of time, like quarterly or annually. And so let's define trade deficit. A lot of us have probably heard the term trade deficit. What does it actually mean in regards to balance of payments? A trade deficit is when we have more money going out than coming in. So we have more money leaving than coming in. So then we'll have more materials coming in than going out. So we end up with a net more material situation. Okay, we have net more materials. We are getting cheaper materials to build a better life for our citizens here in the U.S. An example of this would be, let's say that we have net more material, building materials, right? So we have net more concrete, net more steel, net more lumber. We can take those materials and build better infrastructure for our people here. They'll be able to benefit from those materials. This is a trade deficit. When we talk about having a trade surplus, the definition is we have more money coming in than going out. So more money coming in than going out. We have net more money, but less materials coming in, right? So what happens is we are becoming the producer of the world in those areas, but our citizens are not necessarily benefiting directly from that production of those materials. Example, we have a trade surplus in the United States in pork and soybeans. Because we're at a surplus of pork and soybeans, what that means to our citizens is they're not directly benefiting from the pork and soybeans, the production of the pork and soybeans. We end up with more money, but our citizens don't directly benefit from those products, okay, that we have the surplus. That's a trade surplus. And that's why we have to have balance of payments. You know, we don't determine any of this, but we need to have, okay, we take each item. Do we need a net more materials, or do we need net more money? All right, investment returns. Investment returns. So what are some components of investment returns? Well, we have interest, and we need to know that interest, like we would get off of bonds that pay semi-annual interest, you can get it from checking account, savings account, but interest is taxed as ordinary income. Okay, I need you to write this down, and I'm going to say it a few more times before we go home today. This is important. The ordinary income tax rate, ordinary income, I want you to realize this is the highest tax rate you will pay as an individual. So we don't want to pay ordinary income tax, right? That's the highest tax rate there is. Okay, so keep that in mind. Interest is taxed as ordinary income. Dividends that we might receive from mutual funds, preferred stock, or common stock is also taxed as ordinary income. So interest and dividends are both taxed at ordinary income, which is the highest tax rate we will pay as an individual. The definition of cost basis. This is very important. Cost basis is all the after-tax dollars you put into an investment. It's the money you've already paid tax on. So if you were to put $10,000 in an account and it grows to $12,000, and they ask you, okay, what's the cost basis? You'd say 10, because that's the money you put in that's already been taxed. So cost basis of 10, growth of 2. So cost basis is just the money you've already paid tax on. So you will not pay tax again on cost basis. And then the term capital gains. Capital gains are gains from a sale of a security. You can only have a capital gain when you sell the product, the asset. So capital gains come from the sale. If you sell it for more than what you got it for, that's a capital gain. Another way to look at cost basis. Remember, cost basis is all the after-tax dollars you put into an investment. Cost basis also means principal. So if they talk about little Johnny's principal, that's the money that he put into the account. Little Johnny's cost basis, that's the after-tax money he put into the account. Any non-deductible investment creates a cost basis. All right, so look at me on this one. Okay, very simple. If you invest $10,000, and I'm just making the number up, you invest $10,000 in an asset, and the IRS says you cannot write any of that off your taxes. All that money you put in, you get zero deduction, non-deductible. Well, you put in 10 after tax, you can deduct zero. 10,000 minus zero is still 10,000 of after-tax dollars, which is your cost basis / principal. So if they say non-deductible, that means you've already paid tax on the money. Individual cost basis per share is affected by the stock dividend and splits. We're going to talk about this a little bit later. The only way to change the overall value of the cost basis is to add money to the account or take money out of the account. If you don't do either one of those two things, the cost basis never changes. It could be 1 year, 10 year, 20 year. If you do not add any more money or take any money out, cost basis does not change. And then we talk about transferring assets. How are we taxed when we transfer assets? Well, there's two ways. One is through a gift. In a gift, you're going to have a donor, the one that's giving the gift, and you're going to have a recipient, the one that's receiving the gift. The definition of gift is that the cost basis remains the same as the donor. So basically, in not fancy terms, the donor is just gifting you their cost basis, their after-tax dollars. And when the recipient goes to sell, when they sell for more than the cost basis, that's what they'll owe tax on. So let's do an example. You just found out you got a rich uncle living in Texas. His name's Uncle Ralph. Uncle Ralph's got a $30,000 account that has a $10,000 cost basis. They tell you this in the exam question. Uncle Ralph gifts you the account. You now have a $30,000 account with a $10,000 cost basis because basically Uncle Ralph is just gifting you his cost basis. Now, when you turn around and sell this account for more than that $10,000 cost basis, you're going to owe the tax. If you turned around tomorrow and sold it for $30,000, you would owe tax on $20,000 because it's $20,000 more than the cost basis. That's how you're taxed on a gift. Now, if we use an inheritance, same $30,000 account from Uncle Ralph, but unfortunately Uncle Ralph passed away, you're receiving the $30,000 as an inheritance. Well, in an inheritance, your cost basis steps up to be the fair market value at death. Well, that means whatever value you receive, that is your cost basis. You receive $30,000 from Uncle Ralph in an inheritance, so your cost basis steps up to equal $30,000. Now, if you sell the account for $30,000, there is no gain. So in an inheritance, the cost basis steps up to whatever dollar amount you received, the value of the account. And you will only pay tax when you sell for more than the cost basis. Okay, ordinary income. Okay, that's ordinary income tax. That is the highest tax rate you will pay as an individual. All your earned income is taxed at ordinary income. So what makes up earned income? All earning from employment. So all your job income, any dividends, interest, annuity payments that you receive, all that gets added up. That is considered your earned income, and your earned income will be taxed at ordinary income, which is your highest tax rate you would pay as an individual. We're taxed at what we call marginal rates, and they're progressive. We don't go into all that here because we don't need to, but that's how it works. Term capital gain. Capital gain is the type of income from selling a security. You can't have a gain if you don't sell the asset. Now, definitions. A long-term capital gain is a gain that's held over 1 year. A short-term capital gain is a gain held 1 year or less. Now, the gains are going to matter because they have different tax rates for long and short-term gains. We'll get into that in a second. Capital losses go against capital gains dollar for dollar. You are allowed to write off $3,000 max in losses on any one tax return. You can write up to $3,000 off your taxes in any one tax year. What happens if you have excess losses? All right. For example, Let's say I have $10,000 in losses this year. What's the max I can write off? 3. 10,000 losses minus a 3,000 write-off leaves me 7,000. You can carry over unlimited dollar amounts of losses for unlimited amounts of time. So I just carried over $7,000 in losses. Next year, I'm going to start with 7 in losses. I can write off 3. I'll carry over 4. Next year, I'll start with 4. I'll write off 3. I'll carry over 1. Then I'll write off the 1. All right. Did I write off my $10,000 in losses? Yes. But I didn't write off more than 3,000 in 1 year. And you got to know that. Unrealized gains and losses. Those are gains and losses that exist before a sale occurs. Okay. Here's an example, right? You put in $10,000, it grows to $12,000. You don't do anything. You're a long-term investor, so you leave it alone. That is an example of an unrealized gain. And you will never be taxed on an unrealized gain. You put in $10,000, the market takes it to 7. You're a long-term investor, so you leave it alone. That's an unrealized loss. And you cannot write off an unrealized loss. Now, realized. Realized is when you make the sale. You put in 10, it grows to 12, you sell for 12. That's a $2,000 realized capital gain, and it will be taxed. You put in 10, it drops to 7, you sell for 7. That is a realized $3,000 loss, and you can write that off your taxes. All right, now the tax rates. Short-term realized gain is taxed at ordinary income. All right, look at that. So your short-term rate is ordinary income, which is the highest tax rate you will pay as an individual, period. Long-term realized capital gains is taxed at the long-term capital gain rate. The best way to describe long-term capital gain rate is a better rate for you. It's always a more beneficial rate. Why? Because the short-term rate's ordinary income, which is the worst rate you'll pay. Investors always want to take their gains long-term if they can, because they're going to pay less in taxes. The long-term gain rate is a more favorable rate. And you know that because the absolute worst rate, highest rate for you is your ordinary income tax rate. So hopefully we're beating that into your head. Types of dividends. Dividends can only be declared by board of directors. Okay, they can only be declared by board of directors. With mutual funds, you can take your dividends one of two ways. You can take them in cash, or you can choose to reinvest them. Cash or reinvest. If you choose to reinvest them back into the account, you will not pay a sales charge. No sales charge. That means you reinvest, and write this down, at NAV. If they say you're investing in NAV, that's another way of saying you're not paying a sales charge. So you can take your dividends in cash, or you can reinvest them back to the account at no sales charge. But either way you take your dividend, you'll be taxed in that year at ordinary income tax rate. They are distributing the dividends to you, either in cash or reinvested. You will pay tax, ordinary income tax, on that gain in that year. Some companies will pay stock dividends. That's usually set up as a percentage. So let's say that you own 1,500 shares of a company that just declared a 10% stock dividend. Well, 10% of 1,500 is going to be 150 new shares, 150 new shares. So after the dividend is paid out, you're going to receive 1,650 shares. You'll have 1,650 shares after the dividend. Now for taxes, they're not directly taxable. Okay, it will be used to figure your cost basis for capital gain purposes. All right, but you will not be taxed until you sell those shares. All right, so now we're going to go into dividend payment dates. All right, dividend payment dates. There's 4. Here we go. The declaration date. By definition, the declaration date is the day the board of directors authorizes the dividend to be paid. Remember, dividends can't be paid unless they've been authorized by a board of directors. Period. End of story. Payment date. That's the date you're going to receive your declared dividend. So if you chose to have them reinvested, right, you'll receive them on the payment date. Take them in cash, you receive it on the payment date. They pay you in percentage of shares and added new shares of stock dividend. You'll receive those on the payment date. That's when you receive the dividend. The record date. The record date is the date that the shareholder must officially own the shares to receive the dividend. And then the last one. This is known as the ex-dividend date. Ex-dividend date. Very important, couple of different statements. Ex-dividend date is the first date that you purchase the security and not get the dividend. If you purchase on the ex-dividend date, you don't get the dividend. Now, hopefully that's common sense. Ex-dividend date. It trades without ex-dividend, right? It trades without the dividend. Ex-dividend. If you purchase on the ex-dividend date, you don't get the dividend. If you purchase after the ex date, you don't get the dividend. So you better find out how to figure where the ex-dividend date is. Well, that's easy. It's 1 business day prior the record date. See, on the exam, they either give you an extensive word question or they'll give you a calendar. They will give you the record date. They have to. They'll give you the record date, and then you got to figure out the answer. It's 1 business day before the record date, and they're going to give you the record date. So when you see the record date, count backwards 1 business day. That's your X date. If you want the dividend, you must purchase before the ex-dividend date. Because remember, if you purchase on the ex-dividend date, it's ex-dividend. It trades without the dividend. So you got to purchase before the X date to receive the dividend. Now, I need you to keep all these definitions out. I need you to keep all these definitions out because we're going to go to the calendar.
Make sure you tell them all what you want.
From where?
Papa Nachos.
Oh,
Text
okay. When I get to the next break. All right, thanks.
Yeah, but because they're going to go get it.
Okay.
And we're going to wake up at 5:30.
All right. All right, thanks. Sorry, guys. Family just got back from their weekly trail. They do like 15-mile trails in Austin with my daughter. They just all got back. So there you go. Thank you for having class today because I didn't have to go on the hike. Just say it. Okay. All right. So back to work. So you need to have these dates in front of you, right? Have them out because now we're going to go to Brian's famous dancing turkey calendar, and we're going to work through some examples of this. All right. But you're going to need those definitions out. Okay. So let's set this up in a story form. So Brian is a stockbroker. He's got a client, and the client calls and gave him very specific instructions. He needs our help to make sure he gets this right because it's very specific. So the client calls Brian and says, hey, Brian, I'm looking to purchase a stock. It's got a record date of the 14th. Remember, on the exam question, they're going to have to give you the record date. All right, so here we go. It's got a record date of the 14th. But I have some very specific instructions I need you to follow, man. Okay, ready? I want the dividend. I want the dividend on this stock, but I want you to purchase the stock on the very last day that you can purchase the stock, and I still get the dividend. Clear? Brian says, yeah. Okay. So let's work through this and help Brian out. We know the record date's the 14th. We need to figure out when the ex-dividend date is because he has to purchase before that date to get it, and he wants, and he wants to do it the very last day and still get the dividend. So look at your notes on ex-dividend date. How would we find the ex-dividend date knowing the record date's the 14th? We go to the bullet point that we just covered that says 1 business day prior to the record date. Here's the record date. Does prior mean after, or does prior mean before? Prior means before. So 1 business day before. Is Tuesday the 13th a business day? Yes. So that would be the ex-dividend date. Okay, so we're looking good. Now the client specifically told Brian, purchase on the last day that they could buy and he still get the dividend. All right. If Brian purchases the stock on the X date, the 13th, will the client get the dividend? No, it trades X dividend on the X dividend date. If he purchases after, he won't have it either. You've got to purchase the stock before the X date if you want the dividend. And this client wanted to purchase on the very last day that he could get the stock and the dividend. Is Monday the 12th a business day? Yes. So if Brian, purchases the stock on Monday the 12th, will the client get the dividend? And the answer is yes. Now, do you remember on corporate securities what the settlement date was? Do you remember trade date plus 2 business days? Do you remember that T plus 2 settlement for corporate securities? All right, watch this. Trade date is Monday the 12th, plus 1 business day, plus 2 settlement. Client owns the stock on the record date and gets the dividend. Brian honored the client's wishes to the T, exactly the way he wanted. He purchased on the last day. Client got the dividend. Everybody's happy. All right, let's do another one. Client calls Brian, says, Brian, I got a stock I want to buy. Record date's the 19th. Same deal. I want to purchase the last day and be able to get the dividend. All right, so we're at Monday the 19th. Okay, well, ex-dividend, right, the record date was 1 day before. So if we got record date, so will the ex-dividend date be the 18th? Yeah, no, that's not a business day. Remember, it's the first business day before. So Sunday the 18th is not a business day. Market's closed on Sunday. Market's closed on Saturday. So Friday would be the X date. That's the first business day prior. Now, the client gave those special instructions. Make sure you purchase on the last day that I can get the stock and get the dividend. So that would be Thursday the 15th because that is a business day. If he purchases on Thursday the 15th using T plus 2 settlement, trade date is the 15th, plus 1 is Friday, Saturday does not count, Sunday does not count, plus 2. T plus 1 doesn't count, plus 2 settlement. Client owns the stock on the record date and will receive the dividend. Perfect. One more. Friday the 23rd. The record date's Friday the 23rd. We have to determine the ex-dividend date. Well, the business day before, is that Thursday the 22nd? Nope. The reason we have a dancing turkey, that's Thanksgiving. So nope. Wednesday would be the first business day before. That's our X date. We have to purchase before the X date. If we purchase on the 20th, trade date of the 20th, plus 1, Thanksgiving doesn't count, plus 2, settlement, T plus 2 for corporate or municipal securities. And Brian is honored the client's wishes in all 3 trades. All right, Brian, we've gotten to where we needed to get to.
Paid work.
That was good. Woohoo. Yep, that worked good. All right, everybody. Here we go. Corporate actions. So types of corporate actions. Most corporate actions require a majority vote from the board of directors and the shareholders, okay, before they can implement these actions. One action would be a split. Stock split can be known as a split or a reverse split. They require shareholder approval. So a company can't just say, you know what, let's split our stock. They have to get shareholder approval. Buybacks. Buybacks is when we talk about creating treasury stock. Remember we talked about yesterday when a corporation bought their own stock back from the secondary market? Okay, those were buybacks. Buyback only needs the board of director approval. No shareholder approval. If they want to buy back the stock, they don't need to get shareholder approval, just board of director approval. This is where the company buys their own stock back from the secondary market and turns it into treasury stock. A tender offer. Tender offer requires shareholder approval. It's a type of public takeover bid. Typically what happens is that, say one company, let's say my company wants to take over your company. They want a significant percentage ownership in your company. So they might be willing to tender an offer to all the shareholders, usually at a premium. Like what that means is, let's say your stock today is selling at $10 a share on the New York Stock Exchange, and we'll tender an offer. We'll do $15 a share for everybody that'll sell us their shares. But there's a caveat. We have to receive commitments from at least, and then I give a percentage, a range, like 40 to 45%. We need 40 to 45% of the shares to sell to us. If we get that agreed to, we'll honor our $15 tender offer. If we don't, we rescind the offer. Exchange offers also require shareholder approval. It's similar to a tender offer, but instead of us buying your stock, we will exchange stock. We'll be willing to give you our shares in return for your shares. And again, it's based on a percentage. We give them a percentage, whatever that percentage is, 40 to 45%. As long as we got 40 to 45% of the shares to exchange with us, we would honor the exchange offer. A rights offering. We've talked about this a few times, but that's preemptive right. When they have a rights offering, the common stock shareholders, the existing common stock shareholders, have the right to maintain their proportionate ownership in the company. It does require shareholder approval, and we must honor the fact that existing shareholders have the right to buy the new shares, at least enough to maintain ownership percentage. Mergers and acquisitions. Both require shareholder approval. A merger is when two companies become one, like Exxon and Mobil. Acquisition is when one company takes over another, like AT&T and Singular Wireless. Adjustments to securities. The total value of the portfolio won't change simply because the number of shares change. We need to remember that. And then we have to understand how to compute cost basis per share. Remember, cost basis is all the after-tax dollars you invest in the shares. Okay, so we take that total cost basis, all the money that we've already paid tax on, and we divide it by total number of shares. That gives us our cost basis per share. Now remember, cost basis does not change unless you add more money to or take money from the account. All right, and that leads us to this picture for splits and reverse splits. And this is the third and final picture that Brian and I agree should be on everybody's Einstein sheet. Now, again, we don't tell you what to put. We have 3 suggestions: the bond teeter-totter, the option picture with the max gain, max loss break even, and now we want you to have the stock split picture. Okay. Other than that, any area of weakness that you feel you have, you put on your personal Einstein sheet. Okay. Anything you think is going to help you, it's your call, not me and Brian's. We have our 3 suggestions. That's what they are. All right. So let's go into this picture and why this is important. Almost everybody gets a question on stock split math. So get your calculators ready. We're going to go through that today, and we're going to go through some questions, multiple choice questions, but here we go. All right. When we talk about a stock split or a reverse split, the number one thing we have to remember is that when a company goes through one of these splits or reverse splits, the value of the company cannot change. So if we have $1 million asset company before the split, we have to have $1 million asset company after the split. The value cannot change. So that's number one. Nobody gets richer when the stock splits. The value stays the same. Okay. Now, why do we have a split? Okay. Why would a company want to split? And what happens when a company does split? And this is the importance of the picture. A stock split is designed to reduce the price per share of the stock. Since the value can't change, okay, since the value does not change, then we have to increase the number of shares. So in a stock split, the value per share goes down, the number of shares goes up to keep the value the same. We ask, why would a company want to reduce the price per share? The answer is to make it more marketable. And you ask, okay, well, what does that mean? Well, how many of y'all would rather buy Primerica stock at $150 a share or $50 a share? And everybody screams, 50! So the company might look at doing a split that would reduce the price per share to 50. But if they do that, reduce the price, they have to increase the number of outstanding shares or the number of shares issued to keep the value of the company the same. So stock split is designed to decrease the price, increase the number of shares to make it more marketable for people to afford. A reverse split is designed to drive the price per share up, in turn reducing the number of shares. Now, why would a company want to raise the price of their shares? All right, here's a reason. Stock exchanges have a minimum price that they're willing to let the price of a stock drop to before they delist them, kick them off the exchange. Look, no company wants to get kicked off an exchange. They don't want to be delisted. So if a company feels like they're getting down to that level where they could get delisted, they look at doing a reverse split, because a reverse split then would drive the price of the shares up to get them way above that minimum. Now, if they drive the price of the shares up, they have to reduce the number of shares to keep the value of the company the same. So they drive the price up at a reverse split to keep from getting delisted, to keep from getting kicked off the exchange. And that's what the purpose of this picture is. When you're reading one of these questions, and we're going to do multiple choice on this, right? As soon as you hear number of shares goes up, what are we talking about? Well, it's got to be a forward split. As soon as we hear price is going to go up, right, what are we talking about? It's got to be a reverse split. See, it's just that simple. All right, let's keep going, and then we'll do some examples. So stock split, reverse split. Stock splits are designed to increase the number of shares, lower the market price to make it more marketable for people to afford. Reverse split is designed to decrease the number of shares, increase the market price to keep them from getting delisted, kicked off exchanges. So get your calculators out and ready. Stock split, remember the total value can never change. That's number one. That's how you check your answer. If the value changed between your math on the value of the company before and after the split, if it's not equal, then you did something wrong. All right, so here's your question. Get your calculators out. We're going to show you how to do this. Brian, are you going to start animating that too, like you did on the options this morning?
I probably should.
Yeah, that's a great idea. I mean, I like what you did, so that's why I brought it up. I know you haven't done it yet. All right, so here's your example. Here's the example. We have an example of a 3-to-2 split starting with 200 shares at $60. The question is, after the split, how many new shares do we have and what is the new price per share? All right. When you see the split ratio at 3-to-2, you see a split ratio and there's not a 1 in the split ratio. Okay, there's not a 1. All right, that makes it an uneven split. So this is a 3-to-2 uneven split. If it was 5-to-4, 7-to-3, these would all be uneven, in this case split, because it says split. If it had a 1, like 3-to-1 or 2-to-1 or 4-to-1, if it has a 1 in the split ratio, that makes it an even split. All right, so what do we have to do? Look at your Einstein chart. And I want you to look at that Einstein chart with the arrows up and down. Go to put your finger on split. Split means forward split. Put your finger on split, forward split. Move over to number of shares and tell me, is the arrow pointing up or is the arrow pointing down? On split, forward split, number of shares, what's happening? The arrow's pointing up. So we need this 200 to get bigger. We need the 200 to get bigger. Brian's writing the formula up here. It's very simple. If you want a number to get bigger, then you start with the bigger number in the split ratio. So example, we want the 200 to get bigger. So the formula is going to be on your calculator, guys. Do this on your calculator. 200 times 3, the big number in the split ratio, divided by 2. See, it's up here. Brian wrote it out. You want the number to get bigger? 200 times the big number divided by the little number. 200 times 3 divided by 2. And what does that give us? How many new shares does that give us? On your calculator, 200 times 3 divided by 2. And that's going to be 300 new shares. Did we want the number to get bigger? Yes. Did it get bigger? Yes. So we have 300 new shares. Okay, so it looks good so far. Let's keep going. Now we have a price at $60. I want you to go to the stock split chart, the Einstein page, and I want you to put your finger on split, forward split, move over to price per share. And what is that arrow doing? Forward split, over to price per share, and the arrow's pointing what? Straight down. We want the price to get lower to make it more marketable. So if we want a number to get smaller, here's your formula right here. You're going to enter 60 on the calculator times 2, the smaller number, divided by 3, the bigger number. So 60 times 2, little number in the split ratio, divided by 3, big number in the split ratio. And what does that give us? On your calculator, 60 times 2 divided by 3, that's $40 a share. Well, we started with the beginning value of 200 shares at $60, which is $12,000. So now we have to make sure after the split that we have $12,000. All right. What is 300 new shares times $40 new price? And that's going to be $12,000. We had $12,000 after the split, $12,000 value before the split. So that is our answer. Shares increase to 300, price decreases to 40. 300 times 40 is 12,000, and that was the value that we started with. Let's do another one. On reverse split. All right, in a reverse split. Remember, the total value can never change. Whatever the value is before the split, it's got to be the same after the split. So we're talking about a reverse split here. So let's read the question. We're doing a 5-for-2 reverse split. We're starting with 6,000 shares at $5. First thing you do is take 6,000 times 5, and that's going to give us a beginning value of $30,000. That means after the split, we've got to have $30,000. All right, look at your picture where it says reverse split. Look at the picture, your Einstein sheet. What do we want to happen to shares in a reverse split? Put your finger on reverse, slide over the number of shares, and what's happening? Is the arrow pointing up or is the arrow pointing down? On reverse split, number of shares. And the arrow's pointing straight down. So we need the 6,000 to get smaller. So take out your calculator, and here's our formula. We need it to get smaller, so we're on this formula. Enter the 6,000 times 2, the small number to make it go down, divided by 5, the big number. So the formula, 6,000 times 2 divided by 5. And that's going to be 2,400 shares on your calculator, new shares. We needed the number to go down. So we multiply by the little number, divide by the big number. We have 2,400 shares. Now let's look at the price. Now look at price on reverse split. Put your finger on reverse split, move over to price. What's happening? Price is going up. Yeah, we want the price to get more expensive so we don't get delisted. So on your calculator, 5, and we need the number to get bigger. So 5 times the big number in the split ratio, 5, divided by the little number, 2. So 5 times 5 divided by 2. And that gives us $12.50. All right, looks good. Let's check our final balance. We have 2,400 shares times $12.50. What is 2,400 times $12.50? What's the answer? 30,000. So shares will decrease to 2,400. Price will increase to $12.50. And there's an example of a reverse split. And hopefully you've got these formulas down. You want a number to get smaller, multiply by the small number, divide by the big. You want a number to get bigger, multiply by the big number, divide by the small. Very simple, and you can do it on a calculator. All right, here we go. Let's see what we learned. Got to organize my screen because I got to get Brian out of my way. Oops, that didn't work. I got to get Brian out of my way over here. All right. So here's the question. Get ready with your calculators. Let's show everybody we know how to do this. Okay, a client comes to you and tells you that they have 600 shares of a stock valued at $450, and they got a letter from their company saying that the company's going through a 3-to-2 stock split. Okay, so this is a stock split right here, forward split. Well, how do we know? Because if it was a reverse split, it would say reverse split. It just says split. Split means split or forward split. So we're right here. They ask, what does this mean to me? What's going to happen to me or my stock? You say, okay, let's take a look at the answer choices. It means that you will have 1,200 shares after the split, 900 shares after the split, 300 shares after the split, 600 shares after the split. Okay, so there we have it. Well, it is a split. They want to know number of shares. So on a split and number of shares, what are we looking for? Oh, we want the number of shares to go up. We need a number that's going to be larger than 600 shares. See how easy that was? We need a number that's going to be higher than 600. We know that because the picture tells us that. This is a split, number of shares up. We need an answer more than 600. Let's look at our choices. Is 600 shares more than 600 shares? Answer is no, so D is eliminated. Is 300 shares more than 600 shares? No, so C is eliminated. Just by knowing the chart, we've eliminated half the answer choices. But now we're going to have to figure it out. No problem. We need the number to do what? On a stock split, we need the number of shares to go up. So we start with 600. So enter this on your calculators. 600 shares. We need that to get bigger. So we multiply by the big number times 3, divide by the little number 2. So formula, 600 times 3, the big number in the split ratio, divided by 2, the small number in the split ratio. And what does that give us? 900 shares. And there's your formula. You want the number to get bigger. We needed 600 to get bigger. So we multiplied by 3, the big number, divided by 2, the small number, 900 shares. A client comes to you and tells you that they have 600 shares of stock valued at $450 each. They just got a letter explaining the stock is having a 2 to 3 stock split. They ask you what that means. Okay, we know it's a stock split, so we're right here. They want to know the value per share. Look, $200 a share, $900 a share, okay, $300 a share. Why did the D not load, Brian? That was weird. All right. Okay, so.
You hit Alt-Tab before it loaded.
Oh, that's what I did. Thank you. All right. But anyway, here we go. So this is a split. We're here. They want to know price per share. We are looking for a number that's going down. We need a number that's less than 450. So is 900 less than 450? No. So B is out. It's either going to be A or C. We can figure it out. It's not that hard. We know the formula. We're awesome. We need a number to go down. We want the price per share to go down. So on your calculator, enter 450 times 2, the little number to drive the price down, divided by 3. 450 times 2, the little number, divided by 3, the big number. And what does that give us? $300. So in a stock split, the price per share decreases. We need the number to get smaller. So if you want a number to get smaller, we start with the share price of 450 times 2, the small number, divided by 3, the big number, $300 per share. And there you have it. A company or client owns 4,000 shares of stock in, valued at $3 each, undergoes a 3 to 5 reverse split. 3 to 5 reverse. How many shares does the client have afterward? All right. A company or client owns 4,000 shares of stock in, valued at $3 each, undergoes a 3 to 5 reverse split. How many shares does the client have afterwards? All right, this says reverse split. That puts us right here on our Einstein sheet. All right. Now, they want to know how many shares are we going to have after. So reverse split, number of shares. Arrow is pointing straight down. So we need less than 4,000 shares. Uh-oh, every answer is less than 4,000, so we have to do the math. But it's easy. Reverse split. Want the number of shares to go down. So enter in your calculator, 4,000 shares times 3, the small number to get the number smaller, divided by 5, the big number. So 4,000 times 3 divided by 5. And what does that give you? 4,000 times 3 divided by 5. And that's going to give us 2,400 shares. In a reverse split, the number of shares decreases. So we want the number to get smaller. So we start with 4,000 shares times 3, the small number, divided by 5, the big number. And it gives us 2,400 shares. A company or client owns 4,000 shares of stock in, valued at $3 each, undergoes a 3 to 5 reverse split. What is the value per share the client has afterwards? All right, identify. Reverse split. Come down to reverse split. They want to know what the price per share is afterwards. What is the value per share after? We're on a reverse split. We move over to price. We need a price higher than $3. We need more than $3. Every one of the answer choices is more than $3, so we've got to do the math. But this is easy. We've got it down now. So here we go. Enter $3 price per share. Okay. We need that number to get bigger. So it's going to be 3 times the bigger number 5 divided by the little number 3. $3 times 5 divided by 3. And that gives us $5 per share. See, it's a reverse split. We want the price to get bigger. So we start with the $3 price times 5, the big number, to drive the price up, divided by 3. Gives us $5 a share. All right. And now we're going to turn this over to Brian. That we're going to give you the other way that they could ask these questions.
Sorry, working on your idea of putting in for that stock split stuff for the future.
Told you he works on this stuff. He gets it all done right away. Crazy. All right, go ahead, Brian. Good job.
Sorry, just want to save my work there. Okay, so the idea here, this is going to be a 2-part process that we're going to go through. Don't try and cut corners unless you really know what you're doing here. It's really simple if you just follow what I'm saying here. Because the idea is we're going from 500 shares to 1,500 shares. The number of shares is increasing. So that tells us the type of split it is. It's not a reverse split. Now, if this was going from 1,500 to 500, well, then the number of shares are going down. That's not what it's doing, so we don't need to worry about that. It's going from 500 to 15. Number of shares are going up. It is a forward split. Now, the next part, I don't care if it's going from 500 to 15 or 15 to 5. Don't care. This next part is going to tell us if it's even or uneven. And that is where you take the larger number and you divide it by the smaller number. If that is a decimal, that means it is uneven. Excuse me. If it is a whole number, say a 3, that means it is even. Doesn't tell us anything about it being reverse or forward split. All it tells us is it's even. This told us it's forward. This told us it's a regular split. You need to do both steps. These problems become pretty easy. Clear. Did that once. I'm going to take a picture. So if a client is told that they have stock currently valued at $10 per share, and some actions occurred where now it's worth $25 a share, well, the price is going up. So that tells us that now it is a reverse. It's not an even. It's not a, it's not a forward. Again, we take the bigger number, divide it by the smaller number. If it is a whole number, that means it is even. If it is not, say 2.5, that means it is uneven. Doing both steps gets you down to only one that will be the correct answer. Figure out if it's a forward or reverse using this chart. Figure it's even or uneven simply by dividing whichever number is bigger by whichever number is smaller. If it is an integer, if it is a whole number, no decimal, that means it is even. Jeff?
Awesome, awesome. Uh-oh. What am I doing? Give you a second to screenshot this. All right, I got to get Brian moved out of my way. Move, Brian. Get out of my way. All right, here we go.
Didn't work. He still was able to move me.
I was. He was pushing back. It was hard. It was hard, but I still was able to do it. All right, so dilution and anti-dilution. Dilution means the number of shares that you own remains fixed. Well, can this be a problem? Yeah, it could be. All right, let's use an example. All right, if you had 3,000 shares of a company that issued 10,000 shares, right? So you own 3,000 of 10,000 shares. You are a 30% owner in that company. Now, if tomorrow the company issues 10 million new shares, you now own 3,000 because it remains fixed, right? You now own 3,000 shares of a company that has 10 million, 10,000 shares. Okay, that's dilution. You just lost control, right? You don't have 30%, you're like 0.03%. You got diluted. That's dilution. Anti-dilution is when that can't happen. For example, in common stock, we have the preemptive right. As a common stock shareholder, you have the right to maintain your ownership percentage. So if they sell new shares, you have the right to purchase enough of those new shares to maintain ownership. This is anti-dilution. Convertible securities, same thing. There is a fixed formula for conversion, right? And so it'll convert to more shares so that the fixed number of shares, converts to at issue. So the percentage will be the same. So you can't be diluted based on conversion. You don't lose value just because you convert from common stock, from preferred stock to, say, a bond or something. All right, convertible securities. And then we just did stock splits and reverse splits. All right, the value had to do what? Number one thing we taught, has to stay the same. Anti-dilution. And now we're going to go into types of risk. Types of risk. So systematic risk. Systematic risk is, by definition, risks that cannot be diversified away. These all fall under the category of systematic risk. The most common systematic risk that is talked about is called market risk. The definition of market risk is the market as a whole falls in value. We can't diversify you. You're in the market, market drops. We cannot diversify that risk away. It's systematic. What it means is that's just the way it is. If you're in the market and the market crashes, you lose. We can't diversify that away. That's market risk. It is a type of systematic risk. Then there's interest rate risk. What is that by definition? All right, it's the risk that changes in interest rates will adversely affect you. That's right. Remember bonds? If interest rates go up, what happens to the price of bonds? They go down. It's just the way it is. There's no way to get it to work where interest rates go up, price of bonds goes up. It doesn't work that way. It's systematic. Interest rates up, price of bonds down. If you own bonds, you have interest rate risk, and it's a type of systematic risk because that's the way it works. So inflationary risk is also known as purchase power risk. This is only going to be on fixed income securities like bonds or fixed annuities. And what this is that if you invest in a fixed rate of return, like a fixed annuity that pays 2%, and you're going to do that for the next 20, 30 years to your retirement, you are going to have inflationary or purchase power risk because that's just how it works if you invest in a fixed rate of return long term. You invested a 2% fixed annuity, it's going to take 36 years for your money to double. You put in $1,000 a day, it grows to $2,000 in 36 years. Well, you do have more money, but you're buying a heck of a lot less groceries. Purchase power risk, inflationary risk. It's not, your investment's not keeping up with inflation. Bonds and fixed annuities have this risk. Reinvestment risk. Again, bonds, all bonds, and then callable securities have reinvestment risk. And again, here's how that works. This is the risk that when your bond matures, you won't be able to get when you receive your principal back, right? You won't be able to get as good a rate of return in that investment. Callable securities are common examples of this risk because when do callable securities get called? They get called when interest rates are falling. That's why you only have callable bonds get called with premium bonds selling at a premium. What we're saying is this. You own a 5% bond. Interest rates drop to 3. If it is a callable bond, the company, because the interest rates fall, they're going to call that bond back from you. You're going to have to give them the bond. They give you your money. But interest rates are at 3%. So where are you going to take that money and get 5% again? You're not right now. That's reinvestment risk. Your bond matures. They give you your money. If you can't get the same rate of return or better, that's reinvestment risk. Non-systematic. These are risks that are more easily diversified away. So risks that can be easily diversified away simply by just buying more issuers. All right, so we have capital risk. That's just risk of loss of principal. Business/credit risk. This is the risk that the issuer will go out of business or default on a debt. The business risk relates to the stock. So if you buy one stock and you're worried about that stock going out of business, right? Like COVID hits, you own a restaurant, you have own stock in a restaurant, and they have to close down because of COVID. Drives the price of the stock way down. That's business risk. If you're worried about that happening, the risk on the one stock, buy more issuers. So we can diversify business risk. We just buy more issuers. Credit risk is the risk to the bonds that a corporation issues. Something happens and they're not able to pay you back your money. They default. This is credit risk. And again, if we're worried about that, buy more issuers. Spread out the risk. Call risk. Call risk is only on callable preferred stock and callable bonds. And what it says is when the interest rates fall, the issuer calls in the security and stops your income. Now, it does come with a higher rate of return, and the reason is because you're taking on more risk, the risk that you can be called. So they pay you a little bit more than average. And they're only going to be called when interest rates are falling. Liquidity risk. All right. Liquidity is how fast you can get your money in and out of the market. That's what liquid means. So products that have very little to no liquidity risk, government securities, mutual funds, securities that are listed on any exchange are all considered liquid. You get your money quickly out of the market. Products that don't have or that have significant liquidity risk are going to be things like real estate investing. How fast can you get your money out of real estate? Not very quick. Hedge funds, they can lock the fund. These have liquidity risk. Regulatory risk. When you see regulatory, think rules. So like a change in a rule from a federal government agency would be regulatory risk. I'll use one with FDA. So you wanted to get ahead of this COVID thing. You knew it was going to be bad. So you bought stock in a couple of different pharmaceutical companies, hoping they would be the first ones to the market with a safe, effective COVID vaccination. Oh, and it happened. Your guys came up with the first COVID vaccination. Oh, but the FDA ruled against approving it. So they didn't approve that drug. That's regulatory risk. Because of that rule that the FDA said, we're not going to pass approval on this drug, because of that ruling, you have regulatory risk. Legislative risk is when laws change and that adversely affects you. The most common type of legislative risk would be for tax law changes. So a tax law change would be a type of legislative risk. Legislative means laws. Regulatory means rules. Then there's political sovereign risk. This is the risk that investments, the risk that foreign investments, you only have this with foreign investing. Political climate changes, okay, and it causes you to lose your investment. Political sovereign risk. All right. That's only on foreign investing. Then there's currency exchange risk. This is just the risk with foreign investing that the exchange rates will change and affect your investments. So on all foreign investments, currency exchange risk exists. Also on ADRs, American Depository Receipts. All right, so what is an ADR and how do you have currency exchange risk? An ADR, here's your simple definition. ADR means trading in foreign securities in domestic markets. You're buying foreign securities in domestic markets. This is an ADR. Our big banks buy hundreds of thousands of shares of foreign company stock. They package them in a product called an ADR. So you will purchase an ADR with American dollars from an American bank. Well, if that's the case, then why in the world do I have currency exchange risk? And the answer to that is because you're buying a foreign security. That means the company is from a foreign country, and when they pay out their dividend like companies do, they pay it out in their currency. Let's say you want to buy Toyota. So you buy an ADR that represents Toyota. Toyota declares a dividend. They're going to pay it to the bank who has the shares. The bank's going to receive the dividend from Toyota in yen, in the Japanese currency. Then they've got to convert it to American dollars because they've got to pay you in American dollars. That's how you have currency exchange risk and an American depository receipt. Because the dividend is paid out in the foreign currency. All right, let's talk about strategies for risk. Strategies. How can we mitigate risk? How can we reduce risk? Well, one's diversification. I mean, that's the whole point of a mutual fund, man. A little bit of money invested long-term into several securities managed by a professional. That's the purpose of an annuity. Mutual funds, to diversify the risk. Certain types of risk can be easily diversified away. These are your non-systematic. Business risk, credit risk, legislative risk, foreign risk, regulatory risk. All of these are types of non-systematic. They can be easily diversified away. But some cannot. Some risk cannot be easily diversified away. Market risk. Yeah, market crashes, it's going to go down. We can't do much about that. Interest rate risk. If you own bonds, portfolio is going to be affected when interest rates go up because the price of overall bonds are going down. Reinvestment risk. You invested a 2% fixed annuity over a long period of time, you are going to experience inflationary risk and purchase power risk. There's nothing we can do about it. That's just the way they work. Systematic. Can't diversify away very easily. And then there's portfolio rebalancing. Portfolio rebalancing. Now this is where we move assets around to get you back to your correct percentages. Okay, what am I talking about? Okay, you'll understand this. Let's go to this picture. I sit down with you across the kitchen table and determine suitability. Remember our questions in circles? We showed you a little bit of questions and showed you the circle. So I sit down, we do suitability, and we both agree, based on the way you answered all the questions, your portfolio needs to be made up of 75% stocks, 25% bonds, and we determined this is your portfolio balance for the next 10 years. This is appropriate for you, suitable for you. Okay, perfect. So there we have it. There's our circle. Now, this year happens and stocks blow up, man, in a great way. I mean, it was bullish, crazy. So at the end of the year, this is what your portfolio looks like. You're at 90% stocks and 10% bonds. Now, is that where we wanted you to be? No. Well, yeah, 90% stocks, 10% bonds. That is way more aggressive than what we have you at. We're glad that stocks blew up, but we can't leave it like this. We need to rebalance you. We do this by selling off some of the stocks, purchasing bonds, and now you're rebalanced to 75-25. It helps reduce risk. That's rebalancing, getting you back to where you were, right? We do that once a year. You can, however, but that's it. That's rebalancing. And then we'll talk about hedging. Now, we've done this already, but hedging is protection. It's insurance. Brian's covered this already. This is where you're buying a negatively correlated investment to protect yourself. For example, if you're long in a stock, long means you own the stock. You're bullish on the stock. So you're long. What are you worried about? Stock dropping like a rock. How do you protect? Get an opposite position. So if you're long in a stock, then you would buy a put. Buyers put down. So if the price goes down, which is what you don't want, the put will pay off and get you some of those losses back. So you're using the buying of the put to hedge your long position in case the stock comes down. You don't want it to come down. Brian wants to go to the moon. He wants Primerica stock to go to the moon. He just buys the put for protection. He doesn't even want it to pay off. How many of y'all want your life insurance on your life to pay off? Because what has to happen? You got to die. Okay, yeah, no, I'm good. I have it for protection, but yeah, I don't want it to pay off. Just like the hedge, the option that you're purchasing as a hedge. Brian's betting that stock's going to go up. He wants it to go up. He wants to go to the moon, go to 5,000, go to 10,000. He doesn't want his hedge protection to pay off, his insurance to pay off, but he has it just in case. That's hedge. That's protection. That's insurance. All right. Indices and benchmarks. Indices and benchmarks. An index, that is a statistical tool designed to measure performance of a particular area of the market, segment of the market. The most common one that people talk about, Standard & Poor's 500, S&P 500, which is a measure of 500 large companies in the United States. So if you want to know how the large sector part of our economy is doing, the stock market, we would look at the Standard & Poor's 500 index. And how it's done, that's how the large companies have done, because it's a measure, statistical measure of the top or 500 large companies. Now, we have indices for all kinds of things. Russell 2000, Russell 3000 for like mid cap and small cap. There's Wilshire 5000. Okay, write this down because this is getting tested. Okay, here's one for you. Write it down, write it down, write it down. Lipper, Lipper. The Lipper index measures mutual fund performance right off the exams. Lipper index measures mutual fund performance. If you see Lipper on the exam, that's what it measures. Standard & Poor's 500 measures 500 large companies. Lipper measures mutual fund performance. All right. That's what an index is. Now, a benchmark. Benchmark is where we use an index to measure performance standards. Is this mutual fund manager doing a good job, a bad job? Let's find out. We would use a benchmark. Now, we got to make sure we have a good benchmark, like an apples to apples benchmark. What I mean by that, let's use a sports example real quick. NFL announces that they're going to do a charity football game with the number one high school football team in the country. Okay. NFL playing a high school football team. Very good high school football team. Who's going to win that game?
Depends a lot on which team. I mean, there's
here he
certainly some
comes.
teams that I'm not convinced that the
I
high
really
school
thought Brian was busy. I thought I was going to get run by, but it didn't happen. All right. Brian's favorite team has a star on their helmet. That's what the one he likes to pick on because he has no clue about football. He'll tell you that himself, but he loves to argue and to rile people up. All right, so here's the point. NFL football team against the best high school football team in the country. NFL teams crush the high school football team. Was the high school football team a good benchmark to measure performance of the NFL team against their NFL schedule next year? Absolutely not. Same thing here. You don't want to use a bank account rate of return index to measure performance and see if your growth fund manager's done a good job. They should crush a bank account rate of return. Does that make sense? That's why we use an index as a benchmark to measure performance to see if our fund managers are doing their job. And this leads us into beta. And Brian's going to take over here. But I'm going to start with the story of how this came up because it is getting tested. I fought against all this, but it's getting tested. So now we're all on board. Now, here's the thing. Brian calls me when he buys the Primerica stock. He says, okay, I pulled the trigger, man. I pulled the trigger. I bought X amount of shares at about $85. I said, oh, that's great. So he bought Primerica stock. So I pull up my app that I track my little portfolio, right? And I pull it up. I say, hey, Brian, Primerica's beta right now is 1.5. He says, oh, that's good to know. And I said, look, I'm also looking at AT&T. My mother-in-law owns AT&T. It's been in the family forever. And so I just keep an eye on it. And AT&T is at 0.5 beta. He says, uh-huh. Now, here's what you got to know. Brian's going to explain this. You got to know what that means. Which one's more aggressive? Which one's not? How do you figure it? That's what Brian's going to run through now, and it's being tested, so please pay attention. Brian, you're up.
So the idea here is beta is the risk of the underlying security, the security compared to the underlying index or benchmark. If beta was negative, that means it would simply move opposite what the benchmark was doing. That's what we would expect. A beta of more than one, like Primerica, means the security is more risky than the underlying index or the underlying benchmark. More risk means we are expecting a higher return. A beta of less than one means the security is less risky than the underlying index or benchmark. Less risk means we are expecting lower returns. Alpha is the difference between what is returned, what is actually returned, which has to be given, and what is expected to be returned, which we use beta to calculate. Alpha is generally used as a measure of the effectiveness of a money manager. And the formula is going to be actual minus expected. Why are they not? Oh, there it is. That's why it's loading there. Sorry, now they come up. I'm going to be switching that right. Yeah. Nope. Stop it. Sorry, just fixing the animation real quick. Okay. So let's go through this one. This animation works. So again, Primerica's beta is 1.5, AT&T's is 0.5. We know that because they were given to us. I will be labeling what is given and what we do have to calculate. At this point, they're going to tell us what the benchmark did. Let's say it did plus 10. We know that, again, because they gave it to us. At this point, we can figure out what we are expecting. This we do have to calculate. This is simply beta times the index. So in Primerica's case, they're expecting 1.5 times 10. That is 15. In AT&T's case, that is 0.5 times 10. They're expecting plus 5. At this point, we need to know what they actually did, which does have to be given to us. Let's say that Primerica actually did 18. AT&T actually did 3. At this point, we can go and figure out alphas. Alpha is actual minus expected. Primerica actually got 18. How do we know that? It was given to us right here. They expected 15. How do we know? We calculated it right here. Beta times the index. 18 minus 3 is 18 minus 15 is a positive 3. AT&T actually got 3. How do we know? It was given to us right here. They're expecting 5. Again, we know that because we calculated it right over here. 3 minus 5 is negative 2. Both of those are the respective alphas of those companies with those betas given the benchmark and the actuals. Any questions here? Any questions? Are we good?
All good.
Give it another couple seconds. People may be typing. I think we're good, Jeff.
All right. SIPC, Security Investor Protection Corporation. This was created under the Security Investor Protection Act, SIPA. So SIPA created SIPC. What is it? It's an insurance company protect securities investors in case their broker-dealer becomes insolvent. They go bankrupt. Okay? It's not insurance that if the market crashes, you get your money back. They haven't created that one yet. So what are the rules? You're covered up to $500,000 in total protection per account with maximum protection of $250 in cash. Now, what that means is the total reimbursement from SIPC per account is up to $500,000 in securities. Now, of that $500,000, $250 could be reimbursed in cash max. All right. So it does not include commodity, futures, or similar. Rarely includes margin. Now, it would include margin if they're 100% fully owned. You haven't borrowed against it. Now we talk about a cash account. Remember cash or margin accounts? Cash account you can have 100% securities in a cash account as long as they're 100% owned, like they're not borrowed against. So you can own securities in a cash account. So what's covered or who's covered? Well, per account. So this is the registrations. You can be covered with an individual registration, account for yourself, and you can be covered in a joint registration, like you and your spouse. Okay, so let's use an example. We'll use a husband and a wife. Okay, so what accounts would be covered? Well, the husband could have an account covered up to $500,000 or more than $250 in cash. The wife could have an account covered up to $500,000 or more than $250 in cash. And the husband and wife can have a joint account covered up to $500,000 or more than $250 in cash. If they had kids and had custodial accounts like UGMAs and UTMA accounts open, those would also count separate. Okay, here's the example. Okay, the example is a client has an account with $200,000 in securities and $300,000 in cash. And the spouse has a cash account with $300,000 in securities and $200,000 in cash. They want to know what the max reimbursement total is in this scenario. All right, so let's break it down. Client has a cash account with $200,000 in securities. Can the client be reimbursed $200,000 in cash? Excuse me, $200,000 in securities. Yes. They also have $300,000 in cash. Can they be reimbursed $300,000 in cash? No. The max cash is $250. So the max reimbursement total for the client is $250 in cash, $200 in securities for a max of $450 total protection for the client. Now let's do the spouse. The spouse has a cash account with $300,000 in securities and $200,000 in cash. Can the spouse be reimbursed $300,000 in securities? Yeah, up to $500,000. So $300,000 in securities would be covered. And then what about $200,000 in cash? Could the spouse be reimbursed $200,000 in cash? Yes, up to $250. So the spouse is going to be reimbursed the max of $500,000. $300 in securities, $200 in cash. Max reimbursement $500,000. Added to the client, $450. The total reimbursement would be $950,000 in total protection under SIPC. FDIC, Federal Deposit Insurance Corporation, FDIC. This is going to be insurance on bank accounts, guaranteed not to lose money. These are not securities. This is the federal government guaranteeing your bank deposits up to $250,000. If any bank sells securities on their premises, it's got to be in a separate location and marked, not FDIC insured. Money is at market risk, covered by SIPC. One of the ways we've heard this being asked is, client walks up to the teller at the bank and says, hey, do y'all sell securities? And the teller says, yes. See across the lobby right there in that door, in that cubicle or whatever? Yeah, go right there. They can help you. It's got to be clearly marked. It could be a separate office behind a closed door, marked, or you could walk through a cubicle and sit in a cubicle, but it's got to be marked. The other answer, we don't know. We just hear things. Teller directs them around the corner, up the stairs, down the hallway. Okay. That's fine too, but across the lobby, so they can be in the same lobby, across the lobby, but it's got to be clearly marked on the door or cubicle. All right. They can't say, yeah, see the teller next to me. That's not good. That won't work. All right. So what I'm going to do now is work through types of orders. Basically, I'm just going to give you the definitions. All right. Brian's going to work through how the orders work. We keep it pretty simple. All right. So let's talk about the orders. Now, remember, this is not reality, y'all. The way this is set up, or the way we set this up, is to be able to answer a question on the exam, not reality. Okay. So here we go. Types of orders. A market order. A market order is an order to buy or sell at the next available market price. The way we like to talk about market orders, they're built for speed. We don't care about the price. Order gets called in, just do it. Buy this, sell that. Okay, don't care about the price. That's a market order. Buy this, sell that at the next available market price. Built for speed, not price. That's a market order. Limit order. This is an order to buy or sell at a given price or better. So limit, we are concerned about the price. So we give you the limit price, and it's got to transact at that price or a better price for the client. Now, what does better price mean? Well, if you're buying something, do you want to pay a higher price or a lower price? Lower. So if you put in a buy limit, right, you want to buy at that limit or lower price for you. If you were selling, you'd want to sell at that limit or a price higher than the limit, because that would be better for you if you're selling. Limit, we are concerned about the price. A stop order. A stop order is an order to buy or sell, and once the price has been reached, the order triggers and immediately becomes a market order. So we put in a stop price, it hits the price, it triggers, and now it's going to transact at what? Market order, next available price. That's a stop order. And then we have the stop limit. Stop limit works like a stop, but instead of becoming a market when it's triggered, it becomes a limit. So a stop and a limit price are given. You can have two prices on stop limit. But when you hit the stop price and it triggers, it turns into a limit order. So it has to transact at the limit or better for the customer. All right. Brian's going to take over from here and talk. Oops, sorry, Brian. You're up.
A little far.
You want me to back that up?
Yes, please. Someone's asking about what securities are protected under SIPC up to 500,000. It's a fraud protection. If you invest $500,000 and a week later it's at 100,000, well, you should have picked better securities. There's no fraud there. So be careful. I don't know what it means by protected, but it is for securities accounts. Let me go here. Okay, so the idea, market orders, is just that a bid for speed. But what if the price of the stock is currently 60, but I want to buy it at 50? I really don't want to pay worse than 50. So I clearly want to buy it at 50. If we're talking price or better, that's a limit. The idea is, as this is trading, it may hit 50, it may jump 50, but if it turns around too quickly and goes back up here, I'm not actually going to execute up here. It's got to stay down for at least two tings before I'm going to be able to, 2 ticks before I'm going to be able to actually get it. What if I bought stock at 20 and it's currently at 100 and I'm going on vacation? And I'm a little worried it may fall and go, if it falls to 70, I want to sell it. I don't want to sell it now. Could go up. I want to sell it if it goes to 70. So clearly we want to sell, and it's 70. But the idea here is at 100, I've made 80 bucks. At 70, I've only made 50. I'm losing money at that pace. So I want to stop a loss. That would be a stop order. The idea is, as this is going around, it's going to hit 70 or it's going to jump 70, in which case it's a market order and it's going to then execute at the next available price. I don't care if it jumps up now. I'll sell at 110. I got no problem with that. I only want to sell it, though, if it hits 70. If it just keeps going up, it's never going to matter. Now, the problem, of course, is this could go the way of Lehman Brothers. I mean, I could be watching this go 71.69. That, by the way, is what I mean by jumping 70. It didn't hit 70, it just jumped right over it. And it goes 71, 69, 59, 29, 4. And that's where it executes. Because there may be a whole lot of people ahead of me. In test world, the assumption is the stack is empty. You're going to be the next order to place. In the real world, there may be a whole lot of people in front, and it could go like this. Ugh, that sucks. So what if I do still bought at 20, at 100, we're at 70, but I want to get at least 50. I want to sell it, but I only want to sell it if it hits 70, but then only if I can get 50 or better for it. Well, there's not too many things left. We're clearly talking about a stop limit here. We've got the two, however spell limit. We've got the two prices. The 70 is the stop. The 50 is the limit. As it's bouncing around now, when it hits 70 or jumps 70, now it becomes a limit order of 50. You want to sell at 50 or better. Earlier, when you wanted to buy at 50 or better, you would have taken a number below 50. Now, when you want to sell at 50 or better, you'll take a number above 50. And as long as it stays north of 50, it's going to execute. This is the new picture slide. Whoop. Market orders are built for speed. Next available price. Higher, lower, don't care. Next available price. Limit orders are a price or better. Will not execute for a worse price. Buy or sell, price or better. Stop order is seen as stopping a loss. Wanting a trigger when a given price is hit. It will execute at the next price after. It becomes a market order. resistance and support. If you see those phrases, that also relates to a stop orders. And a stop limit order is going to have it two prices. Want to do something at a price or better, but only after a certain condition has been hit. Any questions here?
Am I good?
Looking good, Billy Ray.
Feeling good, Lewis.
All right, day order. So a day order is an order that fills by 4 p.m. that day or it's canceled. So you place an order, filled by 4 p.m. or it's canceled. I can mark an order good till cancel. That's GTC. Now, if you mark an order good till cancel, here's the deal. That order is not going to expire until it's filled. Okay, good till cancel does not expire until it's filled. The exceptions are all good till cancel orders cancel on the last trading day of April and the last trading day of October. Every 6 months, all GTC orders cancel. Discretionary versus non-discretionary. If any of the 3 A's are missing, action, asset, or amount, it must be in a discretionary account with discretionary authority for the rep to place that order. A solicited order is where a client buys based on the rep's recommendation. This is typically how we would do business. Sit down across the kitchen table, go through suitability, make a recommendation, they purchase off the recommendation. Unsolicited. Unsolicited is where a client requests a security and that the rep didn't recommend. Another way of saying this is we didn't do suitability. We tried to do suitability. They didn't want to answer the suitability questions, or the client just called in and say, hey, I want to buy Exxon, man. Sell me Exxon. Well, let me ask you a few questions. No, I'm good. Buy Exxon. That's unsolicited, okay? We can do unsolicited orders, but we have to mark the order unsolicited. It's very important. So on the application, we would check a box unsolicited. That lets our supervisor know, hey, we didn't do suitability. This is what they wanted to do. Totally legit, but we have to mark it unsolicited. All right, Brian, you're up.
Just doing some cleaning here. So new orders, we've got the immediate to cancel, sorry, getting ahead of myself. This has no time, but yes, partial orders. You must execute the order to the best of your ability immediately. Even if you can only do a partial fulfillment, you've got to try and get it to the best you can with only no time. But you can't have partial fulfillments. The all or none, this is yes time. You do have time. You have all day to get the order, but you cannot do partial fulfillments. It must be done in one trade, one transaction. But you've got all day. And we've got fill or kill. This is no time and no partial orders. You got to do it all at once, and you got no time. If you can't fill it all, you got to kill the order. I did add some text here if you guys want to take a picture of it.
I like the added text. All right, am I good? All right, guys. I gave a presentation today, but I only pretended to know what I was talking about. Fortunately, my audience was only pretending to listen. All right, give yourselves a hand. We have completed the content part of the class. Brian's going to do some cleanup, little housekeeping. Then we're going to go to question and answers. Then we're going to send you on your way. So, Brian?
Okay, oh, there it is.
Am I supposed to click a little? I can't see the... Oh,
Okay,
never mind. You're good. Got it.
We do have advertisements. You can order our concept cards at this site. You can get information about it there. There are discounts. If you get multiple card sets together, they are discounted. The replay of this class Well, not specifically this class. It's the one. Actually, I think it's updated. I think we did it from one of the early January classes. But I have a February class I'm trying to edit to get up there. I do need to change this slide because I did update it. Big words. Be careful of big words. Be careful of universal words on these tests. Words like guarantee, minimum, always, must, all, and never. It's more often going to be one of the softer, one of the vaguer words. The sometimes, the may, the can, the could, the might, the rarely, the usually. I'm not trying to say it's never one of the big words. It just usually isn't. Don't guess them. Both Jeff and I do have additional resources for the SIE. Jeff has his weekly question and answer group for $49 a month that covers the SIE and the Series 6, where I think it's what, 2 hours, hour to a week, where you go through questions from QBank kind of thing.
Big concepts.
I do my study course. The next one actually is starting this Wednesday is the next cycle. It is 6 live 3-hour classes, breaking the material down from these last 2 days into 6 days, so it's a little more time to process and everything. You can find information about them at those sites. One-on-one tutoring is also available. This is our Instagram. The replays are available at that site in the middle right there. Below that, you have the site where you can get information about the flashcards. And you please do complete our survey there at the bottom. All of these links are case sensitive. Jeff?
All right, guys. So Brian's going to release you.
Already have.
And you can ask if you have any questions before we go. You can ask your questions now.
I have a question, Jim. This is Denise. Is it Jim? Yeah, Jeffrey. Can you just repeat the formula for the split? Because I think I didn't write it down accurately. Bigger
Sure.
is equal to bigger number times what divided by small?
If you want a number to get bigger, so if you want the share price to get bigger, if you want the number of shares to get bigger, you multiply by the big number in the split ratio, divide by the smaller number in the split ratio. That'll give you your answer. If you want a number to get smaller, like if you want the price per share to go down, if you want the number of shares to get smaller, you multiply by the small number and divide by the big number, and that'll give you a smaller number.
Okay.
All good?
Hey,
I have
Jeff,
a question.
I have a question, Jeff. I emailed you yesterday about making sure I had the right Kaplan downloaded. Can I just clarify? I have on here the midterm, 2 finals, a practice, and then 2 masteries.
Yep. So you have the new system. So you have final exam 1, final exam 2. So listen up, everybody. This is for everybody. Final exam 1 and final exam 2 are new. They're brand new exams. You can take them multiple times, unlimited times, and they do give you the answers.
Okay.
Okay?
Yes.
Now, instead of giving you 6 times to take the 1 mastery exam, you get 1 time for mastery exam 1, and you get 1 time for mastery exam 2. We need to get a 70% on either mastery exam 1 or mastery exam 2. You can only take them once. That's the new system.
Thank you.
You are welcome. Thanks for bringing that up. So you reminded me. Good job.
Brian, are you able to bring up the very last slide before you did the cleanup?
What last slide?
The one that you said that you had made changes on or added some text on?
On immediate or cancel, it's no time, yes partial. On all or none, it's yes time, no partial. And on fill or kill, it's no time, no partial.
I still didn't get that split thing.
You still didn't get the split, the math on the split?
Oh, yeah, let me just read you what I have. The bigger, you go bigger number times the big number in the split.
If you have 100 shares and you want, or $100, and you want that number, 100, to become a bigger number. You want shares to increase or dollars to increase. You multiply that 100 by the bigger number of the split, then divide it by the smaller number. If you want that number to get smaller, you multiply it by the smaller number, then you divide it by the bigger number.
Okay.
That work?
I'll get it. It's okay.
All right.
Thank you.
You're welcome. We have it. You know, you realize, oh no, unless you took screenshots of the questions, we have those in the answer things. If you screenshotted, did you screenshot the answers to the questions?
I did
Oh, well, then you
screenshot
have
some
it.
of the
Then you have
answers,
it.
so I'll go back.
Then you have the formulas. No problem.
Okay.
We'll walk you
I'll
through
go
word
back.
by word. Yeah, very simple.
All right. Thank
Yeah.
you.
You're welcome. All right. What else we got, y'all?
Hi, Jeff.
Yes. Yes.
Hi, Jeff.
Hey.
It's Miss Tempesta. Yes. I
Hey.
would like to know, how are you doing?
I'm good. Thank you.
I enjoy the class.
Thank you.
Where can I find the new ebooks download?
You just go to my website, thejefftharp.com, and then just click on Primerica webinars, enter the password Primerica, which is with a capital P, Primerica with a capital P, and the green box is download ebooks here. Just click on that. You're good.
Okay.
Yep.
All right. Thank you so much.
You're welcome. Thank you.
Hey,
Okay,
Jeff,
hey.
quick question about the market quote. The we buy, we sell, they sell, they buy. I'm just trying to get that down.
What do you mean? Did you write it down? Or what do you mean?
I'm just asking you to repeat it again, just to make sure I have it
All
right.
right. Well, you have the quote in front of you.
And think about it at a store. If the
Okay.
store is selling at $50 for something and you're buying
Okay.
it, what price are you paying?
The amount
The
that they're
store,
giving.
hold on. The store is selling at 50. What are you buying at?
50.
Okay. Now, if the store happens to be buying from a supplier for 20 and you are that supplier, how much are you selling it for?
20.
That's what the numbers are. What we buy at, they're selling it to us. What we're
I see.
selling it for,
Okay.
they're buying it to it. They're buying it from us.
Okay.
Except they're in the business. Remember, Walmart is buying it for less than they're selling it for. It's their business.
Okay. Okay. Thank you.
Okay, so and for the securities one, for the SIPC, in your example, it says the client had 450 in protection, all 200 of securities, but only 250 of cash. So if they both had 500,000 in securities and 250 in cash, will they both, would that 500,000 in securities be, I guess, whatever, like how is it protected under this example here? I guess I'm not understanding that part.
They only get 500,000 in protection. So if you have the max of 250 in cash, so the client is going to get the 200,000 in securities that they have, but only 250 in cash because they can't get 300 reimbursed in cash. So they get reimbursed 450,000. The spouse had 300,000 in securities and 200 in cash. Well, you can get 200 in cash reimbursed, and you get 300,000 securities reimbursed. So they got 500,000.
Yeah, that's
is that what you're asking or no?
Well, somewhat. So, but if they're both different, like it's under different social security numbers, would that not be?
They are under.
They are under different social. It's a husband and wife.
Husband and wife, they're going to be under. They're not going to have the same social. They're two different accounts.
Yeah, so that's what I'm saying. So would they not both get the max of whatever the security protection
No,
is?
they're covered. They're covered
They
separate.
are. Hold on, Jeff. They are both getting the max. The max is 5.